Right, okay, brilliant. We're not going to waste a lot of time. We're going to directly get into what we have for the day. Okay. So we are once again back to our marathon. In our marathon, we have looked at, we started off with Kaplan mock. That is there. We started off with that. And today, I've been getting requests from so many students. IFRS 18 presentation of financial statements is a bit confusing. We don't understand. Can you please help us with IFRS 18? So I'm going to start off with IFRS 18, do a question based on IFRS 18, and then I'm going to start off the pre-mock September 2025 by ACCA. So we're going to start off with the pre-mock September 2025 with ACCA. All right. So right, so we're going to start off with IFRS 18. So please, you can go to your notebook and say IFRS 18, presentation of financial statements, IFRS 18. So we're going to look at IFRS 18. So you can go to your notebook, and that is a big update from our syllabus, and that is examinable from this session onwards. So we are going to quickly see what is this IFRS 18, and then we are going to start off with we're going to do a question, and then we are going to work with the pre-mock. Okay, superb. Now guys, what is this big hype about IFRS 18? The big hype is very simple. Previously, when we present financial statements, we presented using IAS 1, presentation of financial statements. Yes, it will change. So that's what we are going to see. We're going to see what is the change. Okay. Previously, we had IAS 1. IAS 1 gave us guidelines. IAS 1 gave us guidelines in terms of presentation of financial statements. Okay. So we had IAS 1. So IAS 1 was our primary accounting standard, in terms of presentation of financial statements. IAS 1 gave us the guidelines to present financial statements. But from September 2024, it changed. From April 2024, it changed. And now from September 2025 ACCA exams, you will be tested with IFRS 18 presentation of financial statements. Okay. So when you take IFRS 18, IAS 1 is no more, so IFRS 18 comes into place. So IFRS 18 provides us guidelines in terms of presentation of financial statements. Okay, so IFRS 18 guys comes in and says, hey look, you have your normal content of your financial statements. This normal content, we are going to modify it. We are going to make some changes, little changes, to make sure that the presentation is much more comprehensible, understandable to the users. At the end of the day, one of the objectives of financial statements, qualitative financial statements, is understandability, clarity, my dear. So IFRS 18 says, okay, fine, we are going to make clarity much more enhanced. We are going to make understandability much more enhanced. So IFRS 18 provides five distinct categories to present the financial statements, to present the elements of the financial statements. And the primary difference, the primary update has been in terms of statement of profit or loss, which we are going to look at now. So IFRS 18 comes in and says, hey look, we are providing you five distinct categories to present the elements in the financial statements. So we are going to see what are these distinct categories. IFRS 18 says, hey look, when you are going to present financial statements, make sure these five headings are there. So you please go to your notebook, say IFRS 18, go to your notebook and say IFRS 18 replaces IAS 1. IFRS 18 replaces IAS 1 and provides five distinct, five distinct, five distinct five distinct categories, five distinct categories to present the elements in the financial statements. The elements means assets, liabilities, equity, income, expenses. These are going to be presented under five categories. So IFRS 18 provides us with five distinct categories to present our financial statements, elements in the financial statements. Are we clear? Number one, yes or no? Are we clear? Everybody, are we clear? Yes or no? Are we clear? I think so. Well, you don't like to be the only one.
No, I thought I was expecting a crowd.
I think most of them are online. Are we clear? So IFRS 18 provides five distinct categories. Go to your notebook, say IFRS 18 provides five distinct categories to present the elements in the financial statements. Okay, what are the five distinct categories? Number one, operating category. So IFRS 18 says, hey, look, now you have your business operations, primary principal business activity. Bring that under operating activity. So you will have a heading called operating activities, and below that you will bring it. Are we clear? Understood? Don't worry, I'll give you the structure today itself. Number two, it says investing category. So all your investments that you are making, obviously like how we looked at cash flows, all your investment that you are making, this will capture. Number three, financing category. Your finances of the company, your interest, everything will come under financing category. Number four, income tax category. Your tax paid will come under income tax category. And finally, number five, discontinued operations. Now we studied IFRS 5, non-current assets held for sale and discontinued operations. Correct. Under that, if you have any discontinued operation, gain or loss on discontinued operations, you will show it under discontinued category. Plus, in addition to this, IFRS 18 comes with three mandatory subtotals. IFRS 18 says, okay, fine. When you take the financial statements, you have gross profit total. No, my dear. Gross profit total. Have you heard about gross profit total? Yes, gross profit. It's not mandatory anymore. You don't have to put a gross profit total anymore. Okay. It says you can have only three mandatory subtotals. What are your three mandatory subtotals? So, three mandatory subtotals. Three mandatory subtotals. Below that it says first subtotal has to be the operating profit or losses. Operating profit or losses is a mandatory subtotal. Operating profit or loss is a mandatory subtotal. Number two, profit before financing and income tax. Number two, profit before financing and income tax becomes a mandatory subtotal. And number three, profit or loss for the year becomes a mandatory subtotal. Profit or loss for the year becomes a mandatory subtotals. Are we clear? Now these are the mandatory subtotals that you can have in line with IFRS 18. Are we clear? Are we clear? Are we clear, everyone? Are we clear? Are we clear, everyone? Yes or no? Are we clear? Hello guys online, are we clear? Okay. Big asterisk. Aggregation and disaggregation principles. Say aggregation and disaggregation principles. Okay. Say IFRS 18 requires aggregate items with shared characteristics. When you have same characteristics, you can aggregate and show it together. Aggregate items with shared characteristics, and IFRS 18 requires aggregate items with shared characteristics to be presented together. And in the FR exam, the examiner will mention where to present uncommon items. Okay, now guys, when you are going to calculate ROCE, return on capital employed, okay, or interest cover, return on capital employed or interest cover, you have to use profit before financing and income tax. Say point. ROCE and interest cover now uses profit before financing and income tax. Profit before financing and income tax. Finance cost is replaced as interest expense. Finance cost is replaced as interest expense.
So the mandatory subtitles, operating profits or losses and profit before financing income tax would be the same, right?
Yeah. Okay, and then I'm going to give you how the new format is going to look like. Okay, so let's see how the new format is going to look. Okay, I'm going to give you the structure of the new format. Okay, you have your heading, right? Now what is your heading? Your heading will be statement of profit or loss, correct? All these years it was statement of profit or loss. No, that is changing. Your heading is changing. Okay, now what will be your heading? Okay, now if it's consolidated statement of financial performance. Okay, so Harbin means Harbin statement of financial performance. Clear? Okay, so consolidated, for example, consolidated statement of financial performance for the year ended 31st December 2012, for example. Are we clear? Are we clear? Okay. Now guys, the standard says, okay, IFRS 18 says you are going to allocate it under how many headings, Ashwa? How many headings? 5 categories. Okay. The first category is going to be your operating category, operating activities. So how you will name it is, you will say income and expenses from operating activities. Income and expenses from operating activities. Are we clear? Are we clear? Understood? Okay. Now your revenue is going to be revenue, no problem there. Your revenue is going to be revenue. Your cost of sales is going to be your cost of sales. Are we clear? So you'll have your revenue. You will have your cost of sales. Done. And then you will have your gross profits. But gross profit, is it a mandatory line item? Yes or no? No, but if you want, you can show it. No problem. It's not a mandatory subtotal. But if you want, you can show it. Are we clear? Okay. Plus, if you have any other operating income, you can show it here. If you have any other operating income, you can show it here. IFRS 18 is being taught. IFRS 18 has 5 subcategories. First category is income and expenses from operating activities. Now, if you have income and expenses from operating activities, now this is how you will show it. You will say income and expenses from operating activities, and then you say revenue minus cost of sales, and then you will take your gross profits or losses. So far we clear? So far we clear? But this gross profit heading is not a mandatory heading, not required. It's not a mandatory heading. It is not mandatory. But if you want, you can show it. What is mandatory? Operating profit is mandatory. Profit before financing and income tax is mandatory, and profit for the year is mandatory. 3 subtotals are mandatory. This subtotal is not mandatory, but if you want, you can show it. Understood? Other operating income. Now, under other operating income, you take, if there is any other operating income, you can add it, and then you take your operating expenses. Now, you will take your operating expenses. Now, what are your operating expenses? You will have multiple operating expenses. Whatever the operating expenses that you have, you can directly take it here. If there is selling expenses, selling expenses, you can take it below. Selling distribution expenses. Let's say you have research cost, you can take research cost here. Any general admin expenses comes here. General admin expenses comes here. If there is new items like goodwill impairment, you can show it separately. Goodwill impairment and any other operating expenses. Now, in the exam, your examiner will say, okay, where to put it. In the exam, your examiner will say where to take it generally. Depreciation means your examiner will say cost of sales. So, you can take it directly to cost of sales. Are we clear? Now, what you are going to do? You will do all your deductions. You come right to the bottom. Are we clear? And then you have your mandatory operating profits. You will have your mandatory operating profits subtotal. Now this is mandatory. Under IFRS 18, you got to show this. Are we clear? Under IFRS 18, you have to show it. IFRS 18 gives us how many categories? IFRS 18 gives us 5 categories. Vishma, 5 categories. First category is what? Income and expenses from operating activities. So under operating activities, I have taken my operating activities line items. Now IFRS 18 says, okay, fine. You have taken your operating activities. Look here, you are done with your operating activities. Now move on to your investing activities. any investments that you have made. For example, you have made investment in associate investment will come in, associate share of profits will come in. You have invested in financial assets, that profits will come in. So any investments gain profits will be taken under investing anything, fair value gain in investment property. So you can take all those under income and expenses from investing activities. Okay, so number 2, our second criteria, other than our operating means what? Principal business activity, others can come if you have invested under investing activities. So income and expenses from investing activities. Okay, now when you take this, for example, yes, we can take it here. So we have invested in a property, we are making a gain, no problem. So if I have any gain, any investment gain or loss from investments that I have made can be taken here. I have invested in associate share of profits can be taken. Share of associates profits, not profits, it's profits. Okay, Ashwa, okay? Why you said Ashwa? Because Rahil got arrested. You are happy because Rahil got arrested? You seem to be very worried. Oh, he's arrested. What's happening to him? Don't worry, he's in the hospital. Take it easy. Are we clear? So now, when we have taken income and expenses from investing activities, that is done. Now we move on to what? Profit before financing and income taxes. I have my profit before financing and income taxes. Once again, this is going to be a mandatory heading, correct? This is going to be a mandatory heading. This is going to be a mandatory subtotal. Are we clear? Everyone? Yes or no? Are we clear? Are you okay? How's it going? So our plan today will be doing this. We are trying to finish under this presentation. I am trying to do a question, and I have been asked to do Dargent Co. I am trying to do Dargent Co. and I want to do the pre-mock. September 2025 questions. So I want to see if I can start off that, and then I want to also look into a ratio analysis question. I know it's a bit too much. I don't know if I'll be able to do it everything, but today and tomorrow that will be my plan. Okay, so as much as possible I'm trying to cover. Okay, but anyway, I want to start off the pre-mock questions today. I want to somehow start off so that we know, okay, this is what we are looking at. Understood? Yes or no? Everyone? Superb. Now that I'm done with this, I can move on to my income and expenses from financing activities. Okay, income and expenses from financing activities. Now 5 categories. This is my third category. Altogether, how many categories? 5 categories. This is my third category. Now if I have any interest expense on borrowing, on lease, whatever, then I'll take it here. Are we clear? So my interests are accounted here. Any income, I have any finance income coming in, or if I have any expenses, I'll take it here. So finance income, finance expenses, it can be borrowings, leases, etc. So I can take it here. Done. Now how many headings done? Okay, now first heading. What is my first heading? My investing activities. Okay, my first heading is investing activities. So if you take my investing activities, I start here, I can go on till here. That's my investing activity, correct? Sorry, operating activity. I'm sorry. Operating activities. And then I have my investing activity. My investing activity is over here, correct? So my investing activities comes there. Are you clear? And then I have my financing activities, which comes over here. My financing activities come over here. And then I have my third category done. What is my fourth category? My fourth category will be my fourth category is going to be income tax expense. So I'm going on to my fourth category. My fourth category will be my income tax expense. So income tax expense is my fourth category. So any income taxes that I calculate, I'll be deducting here. Okay. Now that I'm done with this, wait, at this point I have got my profit from continuing operations. I've got to profit from continuing operations. So I have my profit, or if it's loss, profit or loss from continuing operations. So my profit or loss from continuing operations. Are we clear? Then I will have my discontinued operations area. Discontinued category. So discontinued operations. So if I have a discontinued operation, I'll have a loss from discontinued operations. I'm going to show it here. So I have my loss from discontinued operations. I'll show it here. And then finally I'll take my profit or loss for the year. Now I had profit for the year, now it has become profit, simply profit or loss. Are we clear? Understood? So like I told you, we are categorizing the P&L, which was P&L, as financial performance. Our balance sheet is financial position. We are bringing it under 5 headings, 5 categories. These are our 5 categories. Understood? Okay, quickly copy it and give me a done.
So under this we have the ACCA profits and here.
Yes.
So this is tested?
Yeah. If not, you think...
Maybe. See question.
If you ask me how it is tested, it cannot be... There is no major impact in section A and B. Section C, there is a major impact. So it can be tested as a part of section C. Quick. Or quickly take screenshots. Can someone take a screenshot and send it to the group, please? Done.
So today the other guys are not there.
Hmm?
The other guys.
I don't know. I think all of them are online.
So today there are some matching graphics, so that's it.
I heard. Okay, we're going to start off with the past paper question. Yeah, a solid question. And we are going to do it, we're going to start doing it under our normal under our IFRS 18 presentation. Okay, we're going to present it under IFRS 18. Okay, requirement: prepare the statement of profit or loss for Printco for the year ended 30th June 2012 and prepare the statement of financial position for Printco as at 30th June 2012. So there are two requirements. Okay, first requirement P&L and second requirement financial position. But in the exam this time your examiner will not say profit or loss, they will say instead financial performance. Prepare the statement of financial performance. IFRS 18 says financial performance. Are we clear? So our requirement in the exam will be, okay, this is my next question, print. Okay, I will do print statement of financial performance and print statement of financial position. So print course statement of financial performance for the year ended, what's the year end? 30th June 2012. 30th June 2012. So that is my first requirement in the exam. So I'm going to take the heading, I'm going to leave about 30-40 lines, come to the bottom, and then I'll have my financial position. Print course statement of financial position as at, what's the year end? 30th June 2012. 30th June 2012. So we have two requirements, correct? We have two requirements, and then I'll go write down, I'll have about 30-40 lines, I'll go write down and say workings. Are we clear? I'll say workings. Let's go to the question.
So we are doing P&L and SFP together.
Yeah, we can do it together, or we can finish off the workings and come back and do it. Whatever you're convenient and comfortable with, there I don't have a problem. Okay, right. Shall I read the question? Okay, take a minute. Start reading the question. Okay, in the exam, there you go. We are here. Finco is a manufacturing company and has the following trial balance at 30th June 2012. What do you have? Equity shares of $1 each. Equity shares of $1 each. Other components of equity: share premium, retained earnings, plant and machinery, cost, accumulated depreciation, land at cost, bank loan, trade and other receivables, trade and other payables, cash at bank, revenue, production cost, admin expenses, distribution cost, finance cost, and inventory 30th June 2011. Your year end is 30th June 2012. That's my opening inventory. The following additional information is available. On 1st January 2012, your year end is 30th June 2012. So that means 6 months ago, Jan, Feb, March, April, May, June, 6 months ago, Finco raised funds of 30 million. Okay, you raised funds of how much? 30 million. The full amount was recorded in the nominal ledger as a bank loan. Okay, you wanted to raise money, so you raised 30 million. The full amount was taken as a bank loan. The funds actually consisted a bank loan of 16,000. Okay, total your loan that you are trying to take, you are trying to raise capital of how much, my dear? 30 million. Out of this 30 million, they say the full amount was recorded in the nominal ledger as a bank loan. No problem. The funds actually consisted of a bank loan of 16 million and 14 million, the issue of 7 million $1 ordinary shares. Okay, if you actually take it out of this capital, bank loan is also there and share issue is also there. Are we clear? They say bank loan was 16 million and 14 million was issue of shares. So 16 million and 14 million. But what did you go and do? You put everything as what? You put everything as bank loan, whereas it has to be shares. Correct. So interest is payable on the loan at 5% per annum, and accrual for 6 months interest has been included in trade and other payables and recognized as a finance cost. How the calculation was incorrectly based on the nominal ledger balance on 30th June 2012. Now there are two things. Number one, you have to reverse your bank loan because you have taken the entire 30 million as bank loan. Number one, there has to be reversal of bank loan. How much is the reversal that you have to do? 14,000. Are we clear? In other words, you are going for share issue. So you have to account for share issues. Am I right? Okay, now what is your share issue that you are going for? 7 million, you are going for 14 million, issue of 7 million $1 share. So you are going for 7 million $1 share. Okay, so basically your equity share is 1. So you have already raised how much? You are raising 14 million. This is capital, right? So basically what is happening? Your share capital will be 7,000 shares into $1. 7,000 into $1 is going to be 7,000 credit share capital, and then remaining 7,000 into how much? In total 14,000 means into 1. Once again, it's going to be 7,000. It's going to go to your share premium account. Okay. So basically our double entry would be, now I have not credited this. I will credit my share capital. I will credit share premium. My bank loan is overstated, yes, which is a credit entry. Now I will debit my, yes, there you go. Yes, but they have not recorded, no, so we will add it to it. Add it to that, Naresh. So you will debit your what? Bank loan. Your bank loan you will debit how much? In total 14,000. Understood, Naresh? Yes or no? Understood, Naresh? Yes or no? Everybody understood? Yes or no? Okay, superb. Now that's it, done. Number 2, look here, we'll do the adjustments when we come there. An accrual for 6 months interest has been included in trade and other payables. Okay, you have taken, so how did you take 7,000? Okay, now how did I take 7,000? Because it is $7 million one ordinary shares. It's $7 million one ordinary shares, means 7,000 into $1, that is nominal value. The remaining will go to premium. Am I clear, Asna? Yes or no? Number two, what they have done is they have calculated finance cost. Yes, no problem. But their finance cost was incorrectly based on the nominal ledger balance. What is the nominal ledger balance? 30,000. Technically, on how much will you pay your interest? On 16,000. Okay, so reversal of finance cost. Am I clear? So what has happened? Basically, you have charged on 30,000. 30,000 into 5% is what you have charged, correct? In other words, equals 30,000 into 5%, but into how many months? Into 6 over 12, 750 is charged. But actual charge should be how much, my dear? My actual charge should be 16,000 into 5% into 6 over 12, correct? So 6 over 12 6 what's happening into 6 over into 6 over 12 there and into 6 over 12 here. Okay, now basically actual charge should be 400, correct? Are we clear? So meaning they have overcharged. Overcharged how much? Overcharged equals 750 minus 400, 350. So this is to be reversed. Now how do you reverse? Now you have already gone and shown in your finance cost. You would have increased, you would have shown a higher interest cost. Now you have to reverse that, meaning credit your P&L. Credit your finance cost. Credit your finance cost. Debit what? Debit your liability, correct? They say they have taken it to trade payables. Debit your liability. Are we clear? Understood, yes or no? Understood, yes or no? So here they say they have shown an accrual, no, my dear. They say, however, trade and other payables. From trade and other payables, you have to remove it. Clear?
So we assume that we pay finance cost, not trade and other payables, so we have to remove it.
Not assume, they are saying it is included, because when you have to pay finance interest, debit your finance cost, credit payables, no, my dear. They say it is included already. So what you have included already is a higher value. Now it's trade payables is a credit entry. Now you have to debit and reverse the entry. Clear? Are we clear? Everybody tell me, did you understand this or no? Everybody, I want everybody to respond. I've not got response from everyone. Okay, superb. Number 2. Go to number 2. Take a minute. Read number 2. Inventories at 30th June 2012 were initially valued at a cost of how much? 5,700. Inventories were initially valued at how much? 5,700. So inventory has been valued at 5,700. This includes, okay, what is happening? This includes 700 units with a cost of 1,400 per unit. This includes 700 units with a cost of 1400 per unit. In order to sell these items, they need an additional process that costs 400 per unit, at which point they can be sold for 1600. What is the accounting standard? IAS2. IAS2, what does IAS2 requires to do? Inventory valuation. Inventory valuation is going to be at cost or NRV, whichever is lower, in line with IAS2. So what are you going to do? You are going to take the cost, you are going to take the NRV. So inventory valuation, inventory already valued at what cost? 5700. Inventory is already valued at 5700. It includes a cost component. Okay, now what is your cost component? They say it includes a cost component which is 700 units with a cost of 1400 per unit. So that means your cost component you have, which is how much? 1400 into 700, correct? So equals 1400 into 700, which gives you 980,000. That is the cost component. Now you will compare the cost with what? NRV, net realizable value. Now NRV, to get your NRV, you will take your selling price minus cost to sell. What is your selling price? They say the selling price is going to be 1600, correct? So therefore for my 700 pieces, 1600 into 700. Am I right? So that's my selling price. So equals 1600 into 700 gives me 1,120,000. Clear? And then I have my cost. How much is my cost to sell? My cost, if I am going to sell, my cost will be 400 at what? How many units? 700 units. Therefore 400 for 700 units I have to incur the cost. Therefore equals 400 into 700 gives me 280,000. Therefore my NRV is this minus this, which is 840,000. My cost is 980, my NRV is 840. That means my inventory valuation is incorrect. Therefore inventory is impaired. How much is my impairment? My impairment will be 980 minus 840,000, which is 140,000. Are we clear? Meaning I have to account for this impairment. I debit my P&L, I credit my inventory. In other words, my inventory valuation as at the year end, they have given me total inventory valuation is 5,700, correct? Out of this 5,700, I will deduct how much? 140. My net inventory will be 5,700 minus 140. Understood everybody? Yes or no? Understood everybody? Yes or no? Understood everybody? Yes or no?
Sir, I have a small doubt, but it's not relevant to inventories.
Okay.
Sir, so for an investment property, if we are using the fair value model, do we take either let's say we get the fair value? So when we take the fair value, do we take it to the new market value, or is it the market value minus selling costs?
Market value. Fair value is market value.
So we don't take selling costs into
Not
account?
NRV, it's market value. Okay, done. Okay, let's go further. That is done. Next point. At 30th June, read the point on your. Quickly read the point on your. Read the point on your. Read the point on your. Okay, what is happening? What is happening? At 30th June 2012, Printco has a contract. You have a contract to purchase 22,500 electric components over the next 3 years. Over the next 3 years, you have got into a contract. You have got into a contract to purchase what? You have got into a contract to purchase what? You have got into a contract to purchase 22,500 electric components at a cost of 450 each. Every year it's going to be this into 450 divided by 3. These purchases are made at a constant rate, meaning every year it's going to be the same value. 22,500 into 450 divided by 3. Every year you will have the cost. These components are no longer required for the initial purpose. Okay, your initial purpose you knew, this is why you needed it, but now you don't need it. So the initial purpose is lost, but do have an alternative use. Okay, you can't use it for the initial purposes, but you do have an alternative use, which will require an additional manufacturing cost of 600 per component. Okay, if you have to use it for something else, it will have an additional, you have to rework the component, and this reworking will require an additional manufacturing cost of 600 per component. Thereafter, each component can be sold for 900, or you can decide, I'll cancel the contract, or I'll cancel the contract immediately by paying a penalty of 4 million. Any adjustment resulting from this information should be made to administrative expenses. Ignore discounts. Well, meaning, what is the standard? IAS 37, provisions, contingent liabilities and contingent assets. And in this there is a part of onerous contract, meaning you're getting into a contract but you're finding it difficult to fulfill the contract. Why? Because this contract, initially your purpose why you wanted to enter the contract is lost, because the reason for you to enter the contract is lost. Now IAS 37 gives us guidelines. IAS 37 says, okay fine, you are getting into an unavoidable cost. You have an unavoidable cost. There is a cost, but you cannot avoid it. Now, what is your unavoidable cost? You have to incur a payment of 22,500 into 450. The standard says, okay, if you have an unavoidable cost, in other words, an onerous contract, you have to check if you can exit from it. But if exiting is expensive, you can decide to be in it. So you have to do an analysis between staying in the contract or exiting from the contract. Stay or exit. In other words, this is covered by IAS 37. So I think working number 3, whatever. So IAS 37 requires, in terms of unavoidable cost, the following. Okay, what does it require? You have to check, you have to go and calculate lower of, number 1, lower of the cost to fulfill the contract, that is number 1, and number 2, the exit cost. Okay, now you are going to compare both and you are going to choose the most favorable option for you. You are going to choose both and you are going to choose what is most favorable for you. Are we clear? Yes or no? So you are going to choose the most favorable item that is going to be for you. Okay, Subham, let's see. Now you have two options, right? Now number 1, you can decide to purchase the material. Okay, so you don't have a choice, you have to purchase. So your purchase cost is going to be how much? Your purchase cost, my dear, your purchase cost will be, your purchase cost will be 22,500 into 450, correct? So therefore, you can take your purchase cost 22,500 into 450. What's your purchase cost? Equals 22,500 into 450 gives you 1012,500. Now, if you incur this cost, there is an additional manufacturing. So, additional manufacturing cost. Additional manufacturing cost will be how much? For a unit you are going to spend, for a unit you are going to spend 600. So how many units do you have? 600 into 22,500. Your additional cost will be equal 600 into 22,500. Gives you 1,350,000. Therefore, your total cost will be 2,362,500. Am I right? Yes or no? This is going to be a total cost. On the other hand, if you decide after doing this, if you decide to sell, your sales price will be how much? Your sales price will be, no, your component can be sold for 900. So 900, how many component do you have? 900, you have how many component, my dear? 22,500 component. So equals 900 into 22,500 component, 2025 is there with you. Am I clear? Am I clear? Yes or no? Meaning you go ahead with the contract. Yes, you go ahead with the contract, and if you are going to sell, you are going to sell at this point, correct? Or you can decide to cancel off. If you cancel off, there will be a penalty cost. How much will be the penalty cost? 4 million. Now you have two choice. What are your two choice? Your two choices is, number one, to go ahead incur this 23625, or to cancel it and pay the penalty. Which is the better choice? Penalty is better or the first option is better? First option is better. If you go with first option, you will lose 3,375,000. That's going to be your loss. Wait, your loss will be 3,375,000 if you go with the first option. If you go with the second option, your loss will be 4 million. Which loss is favorable for you? The first option loss is favorable for you. Therefore, you are going to provide a provision. In other words, you are going to debit your admin expenses. Are we clear?
So is this for 1 year?
Wait, I'm coming, I'm not done yet. You will recognize the entire provision in the first year. The entire provision of 3,375,000 is recognized in the first year, onerous contract. But you have a liability for how long? Over a period of 3 years. Therefore, you will, double entry will be debit provisions this value, debit provisions this value, credit my current liabilities and credit my non-current liabilities. My current liabilities that I will credit, so it's going to be equal amounts every year, correct? So I'm going to credit equals this over my 3 years. For next year I will have 1,125,000 and my another 2 years, because in total 3 years, right? Next year is my current liability. My non-current liability will be equals this minus this, which will be 225,000. Okay, guys, coming from India, I need about 10 minutes. This question I've already done with you. I'm doing with my other students. I need about 10 minutes. You can stay there in line, no problem. Okay. Okay, guys coming from India, no problems. Give me about 10 minutes. You can see whatever I'm doing. It will be a quick revision for you.
So 22,500 we buy in total of all 3 years, sir. Is it?
Yeah, we are going to incur a loss, no. Now the thing is, you are going to anyway buy it. There you are not coming out of the contract, correct? You are going to anyway buy it. But the moment you buy it, you are going to incur a cost. What is your additional cost? 1,350,000, correct? That is your additional cost, fine. But when you are going to sell, you can only sell it for a low value, correct? meaning your sales price and your cost. When you compare your cost and your sales price, your cost is high. If your cost is high in line with IAS 37, it's an onerous contract. You will have to provide for the loss immediately. So I am providing for the loss immediately. I am providing for the loss immediately today itself. However, my payment will be over a period of 3 years. Therefore, my current and non-current liability, I apportion it and put it. Are we clear? Are we clear? Yes or no? Guys coming from India, I need few minutes. We are going to start. Off the pre-mock FR, which is for September 2025. I'm going to start off with that. So I need few minutes. I'm doing a question. You just have to give me few minutes, about 10 minutes for me to finish this question. Okay. Super. Are we clear? Understood? Super. On 1st July 2011, okay, your year end is 30th June 2012. On 1st July 2011 means 1 year. The directors of P decided to sell a piece of machinery and the asset which met the criteria to be classified as held for sale at that date. You had an asset. The asset met the criteria to be as held for sale. The machine cost 2.4 million, had a carrying amount of 1.5 million. Okay, so you had this particular asset that you have held for sale. The cost was 2.4 million, but the carrying value was only 1.5 million at 1st of July 2011. So when did you decide? On 1st of July, and on this particular date itself, that was the value. At that date, its fair value less cost to sell was 1.14 million when on 1st of July. The machine was sold for 1.1 million after selling cost on 1st of July 2012. When are you doing the sale? 1st of July 2012. So at this point in time, your fair value is there, minus cost to sell. No adjustments have been made to take account of classifying machine as held for sale. So we are going to do it. IFRS 5, non-current assets held for sale and discontinued operations, requires us to carry the asset at net book value, carrying value, or the NRV, whichever is lower. So coming back, non-current asset held for sale. Now they have given you the figures. On 1st of July 2011, they have given you the figure. On 1st of July, you have the cost, which is 2,400. Cost 2,400. Once again, they have given you 1st of July 2011. The carrying value was how much? 1,500. Superb. Once again, on 1st of July 2011, they have given us what? They have given us the NRV. NRV was 1.14. NRV was 1,140. And they say they sold it on 1st of July 2012. When they sold it, the selling price, NRV, your net realizable value, your cost, your selling price minus cost to sell, was how much? 1,100. 1,100. Meaning your cost, your carrying value was 1,500, in line with IFRS 5 non-current assets held for sale, and you have your NRV, which is 1,100, meaning there is a 400 impairment. 400 impairment has to be immediately charged to the P&L. So it's going to be a piece of machinery is what they say. So I'm going to credit machinery. Debit my P&L 400. That is an impairment. Are we clear?
So even though the machine was sold for the next financial period,
As at that point, we have the value, right? Done. The income tax refund for the year has been estimated to be 2.53. It's direct 2,530. It's a tax refund, meaning the company is making a loss. What you will do is debit income tax refund and credit your P&L. So no need to put 3 T accounts or anything, because there is no deferred tax. You will put only if there is deferred tax. So directly what you are going to do, taxes. What do you have? Taxes. In terms of taxes, you have tax refund. How much is the tax refund? They say 2,530. Credit P&L. Credit P&L. Debit tax refund. It will be an asset. Done and dusted. Huh?
The depreciation 0.5.
Where?
So additional information note 5.
Did I miss any point? Oh yeah, I missed point 5. Printco's policy is to depreciate plant and machinery at 15% per annum on cost. Plant and machinery at 15% annum on cost, and to present the depreciation charge to cost of sales. Examiner says cost of sales, we are going to take it to cost of sales. Okay, fine. Let's do that also. Depreciation. Let's do depreciation. Yes, so they are charging depreciation at what rate? We are charging depreciation at 15% per annum on cost. Okay, so we have plant and machinery. Okay, so what do we have? Plant and machinery. Let's go to plant and machinery. Let's go to plant and machinery. Plant and machinery cost is 16,200. Accumulated depreciation is 1,290. Correct? So equals 16,200 minus 7,000.
Depreciation is on cost.
7,290.
இல்லைங்க பேசுறதே கேட்கலாம்
Minus 7,290, 8,910. And then out of this you have to remove your non-current asset held for sale. Correct? How much is your non-current asset held for sale? Your non-current asset held for sale is 1,500. Net book value is removed. Non-current asset held for sale 1,500. Therefore, this minus this, that gives you 7,410. So for current year depreciation, how much will be your current year depreciation? They say your current year depreciation is going to be at 15%. Okay, so 15%. 15%. So take your 7,410 into 15%, which is going to be 1,115. But your depreciation is going to be how are you going to calculate your depreciation? Think and tell me, guys. Whoever just joined now, from India, give me about 5 minutes. I'm almost done. I'm finishing a question. Just give me 5 minutes.
You have to remove the excess depreciation.
Okay, tell me how much.
400 into 15%.
Tell me.
No, wait. Because in fact, at the end, so there's no excess depreciation.
Okay, calculate and tell me then.
So I have a confusion, sir. Plant and machine, sir.
Hmm?
How do you get 890?
Cost price depreciation.
How was the depreciation?
Yeah, accumulated.
So I think
You don't think you do it? Depreciation. Answer. Quick.
We have to remove 54
Mm-hmm.
because the fair value at first July was 1.14 million.
Okay.
Impairment was 360 and we have to
Okay. Okay. I want to see the question. Okay. Someone says they want to see the question. Okay. Do it. Let's see. Okay. That's right. That's right. Got it. So Prince policies to depreciate plant and machinery 15% per annum on cost and 10% depreciation charge in cost of sales. Okay, what is your cost?
Cost is 2,400.
Cost is 16,200. 16,200.
Doesn't that accumulated depreciation already have that depreciation charged on?
Okay, come. Wait. Hold on. How much your cost? 16,200 is accepted. So basically, this is your net book value, correct? Your cost. Your cost is 16,200. And from this, what is your value on non-current assets that you are taking? Non-current asset held for sale is 2,400. So minus 2,400, correct? It's on cost equals sum. How much? 13,800. So you got to be careful in the exam that you don't confuse between net book value and cost. But in this, how many percent is depreciation? 15% is depreciation equals this into 15%, which is 2070. Because non-current asset held for sale has to be removed from the equation. You debit your depreciation 2070, credit accumulated depreciation. Are we clear? So basically this becomes not relevant for us.
So what about the impairment that happens on the 1st of July 2000?
Okay, when we are going to adjust it. Wait. As a part of my property, plant and equipment, I'm going to adjust it. So what will be my net book value? What will be my net book value? What will be my net book value? Here itself, let's calculate the net book value in the exam so that it's easy for us. What will be my net book value? Net book value. Okay, think and tell me. What will be my net book value?
I think we got the impairment.
Don't think. Tell me exactly.
Not sure.
5340?
Everybody? How much will be my net book value? I have my plant and machinery. How much is my plant and machinery? Now I have my net book value, plant and machinery, which is 8,910. That is correct, no? From this I have to remove my non-current asset held for sale, correct? So technically I can remove my 1,500, correct? Minus 1,000, correct? Non-current asset held for sale is removed. And then of course I have my depreciation. How much my current year depreciation? 2070. Therefore my net book value will be 5,340. I can directly take into balance sheet, statement of financial position. Are we clear? Okay, guys. Whoever they are throughout this question, I'll do the financials later today. But whoever has joined at 3 o'clock, we can start off with the pre-mock, because I'm here to start off the pre-mock today. So that's going to be the plan. Okay, fine. So we will do the income statement balance sheet once I'm done with the pre-mock question. I want to start the pre-mock. Okay, super. So I'm gonna log into my ACCAglobal.com and we are gonna do it on the real ACCA platform. Okay. Anybody who has gone through the pre-mock already? Anybody who has gone through the pre-mock already? You do not know that it is there.
So I knew there was one, but I didn't open to do it.
Anybody who has done it? No?
So how difficult is the pre-mock to the actual paper?
Let's see. Let's do it and see. Okay, nobody has done it. So it's okay to start off. So we're going to start off. I don't think I can do everything in terms of pre-mock. I cannot complete entirely, but we will start off with section C right no today. But entirely over this marathon I will finish it off. Today I'm going to start off with section C, and then slowly we'll move on to section A and B. Section C, let's try to see as much as possible to finish. Okay, superb. Anyway, because nobody has done it, when you are going to do it on your own, it's going to be really, really helpful for you. Pre-mock, FR, okay, why cannot,
That's because it's set to offline or something.
huh? Why can I not? Okay, how do I go to settings? Hold on, it's loading. Why does it take such a long time to load? Is it the same with you all also?
I'm able to open mine.
Huh?
I'm able to open.
You're able to open yours. Okay, then why am I unable to open mine? But here there is a pop-up option that comes in for Safari, so I'm just trying to see if I can get that at least. There's Safari, sharing extensions. Hmm?
different ACCA
It has to work now. Why doesn't it work? It takes some time to load. No, but I was doing it yesterday.
All and reassign that.
No, here this is not getting open, so I have it here. I'm not sure why it's not getting
It's
open.
go to all.
Alt.
Yeah, all. That.
Where is all? Okay.
All.
No. There is a pop-up option that needs to be enabled here.
maybe browse and then like
Where?
go to browse and then reassign.
There is a pop-up block option. It generally. There is a pop-up block option. Here, there you go. So apps. I don't know how to remove that. Guys, any idea, guys, online? Oh dear. You know? No, they have actually, someone had used it. One of my staff members have used it here. ACCA. There you go. Okay, loading. Oh yeah. Okay, we have been directed. Okay, this is our FR pre-mock 2025 exams. There you go. We've got it. Okay. The thing is, I have section A, all these questions to do. Section B, all these questions to do. But I'm moving on to section C. I'm going to start off with section C and then I'll come to section A and B. Okay. So this is your ACCA platform, my dear. Everybody, you're with me? You're with me, everybody? Everybody, you're with me? Everybody with me? Okay, superb. This is your ACCA platform. This is how your real ACCA exam will also look like. Okay, your real ACCA exam will also look like this, and then you will have your space here to answer. Are we clear? Are we clear? Okay, so we're going to do it together, but I'm not going to do it under exam timing. Okay, I'm going to explain and do it. But if you are looking at exam timing, I have already shared videos with you where I'm working on exam timing. Please watch it. Please watch it on exam timing on the real platform. I'm doing it in class. I can't do it under exam timing, but I will try to explain and do it. Okay. Superb. I want all of y'all. There's about 45. I want all of you to right away log into this. How did you unblock the pop-up window? Go to Safari settings or directly go to Chrome. In Chrome you can, or just Google how to unblock settings. Okay, I want all of you to log into this platform through your original ACCA account and give me a done. I want everybody to log into your ACCA login your practice platform and give me a done. I'm waiting for you. I'm giving you about 5 minutes. Okay, I'm giving you 5 minutes. I want all of you to log into it. I'll be back soon. Okay, shall we start? Requirement. Explain the discovery of the inventory defects. Explain how the discovery of inventory defects would affect the financial statements of Mervyn Co. for the 2018 financial year end. Explain how the discovery of inventory defects. 3 marks. So probably I think there is some inventory defect somewhere here. Okay, they want to know within the notes there is a inventory defect. How will that affect? How will that affect the financial statement? So I have not read the question. No, I'm only reading the requirement in the exam. I have not read the question, so I'm going to just leave it like that. I'll come back. Okay. How can I go navigate? Okay, that's next. Prepare a schedule of adjustments to the draft profit list in the trial balance, taking into account the additional information notes 1 to 5. 1, 2, 3, 4. Sorry, 1 to 4. 1 to 4, they want me to take the profits and then work through the profits. Your examiner's one of the favorite requirements. Adjust the profits. Number 3, they want us to prepare the statement of financial position of Mervyn. 9 marks, 8 marks and 3 marks. So in total 20 marks for me in the exam for this requirement. This is the pre-mock exam. This is the pre-mock exam for September, and we are going to see how to do it. So your examiner wants you to prepare a schedule of adjustment in the exam. I'm going to take my schedule. Sorry? Part A we can do it later because we have not read the entire question. No? So schedule of adjustments. Okay, now I'm having problems with my, because I'm using an iPad, guys. Since I'm using an iPad, I'm having problems here working through this. I'm using an iPad, guys, so my iPad is not picking up the blank in the software. Okay, can I do it on Excel, because it's going to look the similar schedule is there on Excel. So can I do it on Excel? Okay, you can do it on the platform because you have your laptop. I'm using an iPad. You can use your laptops, no problem. Okay, so I'm gonna come back here. I'm gonna do it over here, pre-mock. Okay, this is how in the exam your real ACCA platform is going to look like. Okay, we know that, but I'm going to do it here. Okay, it's a bit inconvenient for me, So let me take the full screen. Okay. Prepare a schedule of adjustments to the draft profit list in the trial balance. Okay, so I'm gonna say schedule of adjustments to profits. Schedule of adjustments to profits. What is the company name? Mervin. Guys, just give me a second. I'll change my keyboard. Okay, my keyboard is a bit annoying. I'll change it. Okay. Schedule of adjustments for profits. Mervin. That's the name of the company, right? Okay, I've already taken it on top. Okay, now we have the question. Now in the exam we can read the question. Okay, let's go to the question. Okay. What is the question? Mervin Co. has prepared a draft trial balance at 31st December 2018. What do you have? Property, plant and equipment carrying amount 36,000 and they have given us a note. Factory cost 7,500. Share capital 10,000. Revaluation reserve note 1,600. Retained earnings brought forward 1st of January 2018 55,740. Draft profit for the year ended 31st December 2018 4,500. Provisions for warranty 5,000. Dividends paid 7,240. Current tax payable 2,800. Inventories at 31st December 2018 8620. Trade receivables, cash, loan and trade payables. And then they have given us the following notes. And what is the requirement? Prepare a schedule of adjustments to draft profit listed in the trial balance. How much is the draft profit, my dear? Everybody. How much is the draft profit, my dear? Everybody.
4,500.
Everybody. How much is the draft profit? How much is the draft profit? Draft profit is 4,500. So you're going to take 4,500 and make adjustments to it. So draft profits prior to adjustments. How much is it? 4,500. And then you will have your adjustments in the exam. And then you will have your adjustments in the exam. And then you will get your corrected profits. Correct? And to do your adjustments, obviously you know there are workings. We will start doing the workings also. Are we clear? Are we clear? Super. Let's go to the question. Mervyn Co. has been constructing a second factory since 1st of January 2017. What's your year end? Your year end is 31st December 2018. Correct? On 31st August, meaning during the current year, on 31st August 2018, the construction of the factory was completed. During the year, they completed it. So, in January 2017, they started. 31st August 2018, they completed, meaning 1 year gone, 8 months gone, 1 year, 8 months gone. The construction of the factory was completed and at this date, it was ready for immediate use. It is ready for use. At 31st December 2017, that is last year, the carrying amount of the factory under construction was correctly calculated. The carrying amount of the cost of the factory has been correctly calculated. At how much? 8 million. The cost incurred in the current year, until last year it's done, the cost incurred in the current year were as follows. Material, labor and subcontractors 5,000, other directly attributable overhead cost 2,000, administrative overhead cost 500. All of the above cost has been recorded in the factory cost account in the above trial balance. In the above trial balance, 7,500 is already recorded. A specific loan of 18 million was obtained in 2017 to fund the construction of the factory, and it carries an annual rate of interest at 10.5%. The loan was still outstanding at 31st December as at the year end. All interest on the loan has been recorded as an interest expense in the P&L for that period. M depreciates factory building over 20 years. No entries have been made in respect of the depreciation of the factory in the year ended 31st December 2018. Entirely it is note 1. So when you take note 1, they are testing you with multiple accounting standards. It's not just one accounting standard, they are testing you with multiple accounting standards. So here, Mervyn Co has been constructing a second factory since 1st of January 2017. On 31st August 2018, the construction of the factory was completed and at this date it was ready for immediate use. At 31st December 2017, the carrying amount of the factory under construction was correctly calculated at 8 million. The cost in the current year was as follows. Okay, you had your last year value 8,000 and current year value which is 7,000 500, which is made up of material labor and subcontractors, other directly attributable overhead costs and administrative overheads. And out of everything they say the 8,000 has been included correctly, so nothing to worry about the 8,000. 7,500 has been included this year as your factory cost. 7,500 cost here is correct or incorrect? Do you have any problem there? Incorrect. Brilliant, because there is admin overheads of 500. Admin overhead assets are recognized at cost. IAS 16 assets are recognized at cost. Cost means all expenses incurred to bring an asset to its intended use. All the expenses are fine, but administrative overheads 500 cannot be included as a part of your assets cost, which is included. Now what you have to do is you have to remove it. So coming back, workings, working 1, IAS 16, assets recognized at cost. So all expenses incurred to bring an asset to its intended use can be capitalized. However, now you have taken admin expenses which cannot be taken as a part of a factory cost, which needs to be removed. Are we clear? Okay. So admin overheads cannot be included as factory cost. Therefore has to be removed. Are we clear?
So do we have to mention the standards?
You don't have to, has to be removed. Okay. Now Zian, you are giving notes like this. Should I include in the exam? No, you don't have to. You can directly go and say, hey, look, you can't include admin cost. Here, you have already included admin cost. So basically it should have gone to P&L. You are going to debit your P&L. You're going to debit your P&L how much? 500. It's included as a part of my factory cost. So credit factory cost. How much? 500. You can simply do that. I'm fine with that. No problem. In the exam you do that. I'm fine with that. No problem. So basically when you take my P&L, my cost should go up or come down? My cost should go up. My 500 which I should have taken to my P&L, now I have taken it to my cost of the asset. Now my cost should go up, meaning adjustment here. What is happening? I'm having admin overheads. Admin overheads. Why does it go up? Admin overheads. How much am I going to adjust?
500.
I'm going to adjust 500. I'm going to adjust 500, meaning this should go up or come down? I am working with my profits. My cost is going down, means my profit should come down. My cost, admin cost should go up, means my profit should come down because I'm working with profits. Are we clear? My cost is going up. I'm debiting my P&L. If I'm debiting my P&L, my cost is going up, therefore my profit is going to come down. Got it, everyone? My profit is going to come down. So therefore minus 500. Understood? Understood? Everybody, you can work with me, no problem. You can work with me on your platform. I want you to work in the platform, not on Excel, but I'm working on Excel. Okay, understood? So, next. Oh, okay, I can. Okay. All the above cost has been recorded in the factory cost account in the trial balance. Okay, we have reduced the 500. A specific loan of 18 million was obtained in 2017 to fund the construction. Okay, to fund the construction, I'm borrowing standard. IAS 23 borrowing cost. Working 1 done. Working 2. borrowing cost. Now what is happening? To fund the construction, I'm borrowing. How much am I borrowing? 18 million. For the obtaining 2017 to fund the construction of the factory, and it carries an annual rate of interest of 10.5%. The loan was still outstanding at 31st December 2018. All interest on the loan has been recorded as an interest expense in the P&L. What does IAS 23 say? IAS 23 says, yes, you are bringing an asset to its intended use. So you are particularly purchasing this loan, getting this loan to bring an asset to its intended use. Therefore, the interest, the finance cost on the loan can be capitalized until the asset is ready for use. When is the asset ready for use? The asset is ready for use in August. So Jan, Feb, March, April, May, June, July, August, for 8 months technically you can capitalize, but instead for the entire year they have expensed. They have already done the expense, but now what you should do, you should reverse it. So therefore your total borrowing cost will be 18,000 into 10.5%, that is for 1 year, am I right? But how much can you capitalize? You can capitalize for 8 months, correct? So into 8 over 12 can be capitalized. Therefore equals 18,000 into 10% into 8 over 12, which is 1000, 10.5%, I'm sorry, 10.5% into 8 over 12, which is 1260 can be capitalized. But I have already gone and expensed it. If I have expensed it, my profits are understated. My expenses are overstated, my profits are understated. Now I have to reverse it, meaning I have to credit my P&L. So I will credit my P&L and I will debit what? My factory. My factory will be debited, meaning my factory cost will go up.
So do we have to show this double effect?
Better.
So factory cost will go down.
I have not capitalized, now I have to capitalize. This 1260 I have not capitalized, no, I have expensed, no.
Interest expense.
Yes.
So factory increases.
Of course, my factory increases. Are we clear, everybody, guys? Guys online, are we clear? Yes or no? Are we clear? Yes or no? So I'm going to go to the top. I'm going to come here. Okay. Now my profit should go up because I have expensed, correct? So borrowing cost reversal, correct? I'm reversing my cost. So how much is that? 1260. Now I need to add this, so I'm gonna add it. Done. Understood? Let's go further. And number 3, Mervyn depreciates factory building over 20 years. No entries have been made in respect of the depreciation of the factory in the year ended 31st December 2018. So number 3, working number 3, W3, depreciation. My depreciation, how much will be my depreciation? Anybody depreciation? Guys, my dear, depreciation will be an adjustment in every exam session, okay? You will get depreciation, okay? Depreciation. This is the first time I am doing this question, so I do not know. I will not know. Spot on, I will not know. Anybody with depreciation? Anybody? Hello, this is your mock. This is your real ACCA mock.
So I get 830.
813.
Sure. So would you scroll up?
Hasna 352. Asim, how much? Rubini, Hajara.
So the year end is 31st December 2018.
Now tell me. Now tell me. Asim,
So sir, we
394. Zameen, 813.
so we capitalized for 4 months.
I don't know, you have to tell me. Think. For how long should you capitalize? Your asset was available to be used from September. So your depreciation will be applicable from when? So now how much? Now how much? So depreciation, factory. What is the cost of the factory? Your cost of the factory will be how much? 7,500 minus 500, which is 7,000. Plus you have borrowing cost. Correct? Which needs to be added. How much is that? 1,260. This is the cost of the factory. Yes or no? Yes or no? No. You have a cost already coming. This is only current year cost. You have your initial cost also. How much is the initial cost? Initial cost is 8,000.
But that's the carrying amount, right?
Yeah, so they are taking the total cost, right? You have to take only now it's completed, right? It's the cost, right? So the total cost only now you have completed the asset. Meaning in total plus your 8,000, meaning your total will be how much? 16,260. How many years? 20 years. Equals 16,260 over 20 years, which gives you 813. Some of you all yes got your 813. I saw some of you have got 813. That is partially correct. Because you are done in August means September, October, November, December, 4 over 12. Some of you, good job. Okay, some of you equals this over 12 into 4. Is this happening, man? So equals this over 12 into 4 gives you 271. Correct. So from the point of usage, September, October, November, December for 4 months. Are we clear, everyone? Are we clear, everyone? Look, you get caught. You get caught because you have not read the question properly. Debit depreciation, credit what? Accumulated depreciation. Debit depreciation and credit accumulated depreciation. So my profits should come down or go up. My profit should come down or go up. Come down. So I go to the top. I'll say depreciation equals minus, I come down, how much? 271. Understood? Yes or no? Understood? Yes or no? Okay. Only now the first adjustment is done. Only now the first adjustment is done. Now we are moving on to the second adjustment. Let's go to the second adjustment. The revaluation reserves relate to M's head office. Okay, where is revaluation? We saw revaluation 1600. So that relates to M's head office at 1st of December 2018. 1st of December 2018 means during the current year. Now, just 1 month. Your year end is 31st December. At 1st of December 2018, during the current year, it was discovered that the head office had been damaged due to a storm, resulting in an impairment loss of 2 million. This has been included in the calculation of the draft profit before tax, and it is reflected in the carrying amount of the property plant. In the calculation of the draft profit before tax, and is reflected in the carrying amount of the property plant and equipment. It is reflected. It is reflected. Depreciation on the head office has been calculated and recorded correctly. Depreciation in the head office has been calculated and recorded correctly, so you don't have to do anything. M does not make a transfer from revaluation surplus to retained earnings in relation to revalued assets. What is it? What is it? IS 36, superb. What? Reversal of impairment. Reversal of impairment. Basically, what they have done, they have taken the impairment cost to the P&L. But technically, you have revaluation. The standard says for that particular asset, if there is revaluation, first go and set off against the revaluation. But what did you do? You went and took the entire amount to the retained earnings, meaning your rate and your profit has come down. The revaluation reserve relates to M's head office. At 1st December 2018, it was discovered that the head office had been damaged due to storm. They are saying directly this revaluation is relevant for head office. And there has been an impairment. So first, what should you do? If you have revaluation, the standard requires you to set off against your revaluation. But what did they do? They have directly taken it to retained earnings, meaning your retained, your profits are understated. But what is the maximum value can you set off? Can you set off 2 million? No, because here the maximum you can set off says only 1600. Because your revaluation is how much here? 1600, right? So maximum you can set off is only 1600. So out of this 2000, you can reverse 1600. Anything extra can take it to retained earnings, no problem. So next point, working number 4. Working number 4, reversal of impairment. So 1600 to be reversed, 1600 to be reversed from profits. Are we clear? Where do you take it? To revaluation reserve. So I'm gonna debit my revaluation reserve 1600, credit what? Brilliant, credit P&L 1600. Meaning my profit is going to go up or come down now? Brilliant, my profit is going to go up. Impairment reversal 1600. Now I'm going to add it. Guys, everybody, are we clear? Guys, everybody, are we clear? Guys, everybody, are we clear? Got it? Got it? Got it? Yes or no? Everybody. Okay, let's go further. I mean, it can't get this easy, right? I mean, this is easy. This is not technical. This is easy. Very, very easy. Very easy. Compared to the questions that we have done in the past, you can't even compare. No, actual paper has to be easier than the mock if you are prepared. But aren't you all prepared? How long to go? 2 weeks to go? 12 days. Today is the Saturday. Next Saturday, next Thursday. Okay, superb. So you know, right, we are meeting next Saturday, Sunday also. I'm meeting you tomorrow. I'm meeting you next Saturday and Sunday also. I'm meeting you next Saturday and Sunday also. Okay? Okay? Superb. Mervyn estimates its provisions for warranties based on past experience. The provision for the current period has not yet been calculated or recognized. The information below has been compiled by management for the purpose of calculating the required provision at 31st December 2018. Standard. What is the standard? IS 30? IS 37. Okay, superb. Do the calculation for me. Tell me the calculation. IS 37. Do the calculation. Tell me the calculation. Do it.
Could we show the trial balance?
Could I show the trial balance? Just a second.
There's an increase in provision.
There's an increase in provision. Increase in provision of how much? Increase in provision of 1,060,000. Okay, provision brought forward. Okay, working number 5. Provisions IAS 37. Okay, now based on this, we can obviously provide for provision. Okay, brought forward provision is how much? 5,000. Current year, you have to calculate. Correct. So current year, let's do the calculation. Okay, what is happening in the current year? They say M estimates its provision for warranties based on past experience. The provision for the current period has not yet been calculated or recognized. The information below has been compiled by the management for the purpose of calculating the required provision. At 31st December 2018, product A, product B. So you have two products. So product A, product B. Product A, units sold 25,000. Product B, 1,100,000. Okay, superb. Probability 15%, 30%, 15% and 30%, and then expected cost is 32 and 18. 32 and 18. Therefore, equals this into this into this. 120,000 for product A, 5,940,000 for product B. Therefore, my total provision that I will have to provide has to be divided by 1000. I'm working to thousands, right? 6,060. So already 5,000 is provided. Already 5,000 is provided. So my carried forward will be 6,060, correct? So current year will be 6,060 minus 5,000, which is 1,060. Out of 6,060, 5,000 is already provided. There is an increase of 1,060. So debit provisions in the P&L and credit provisions liability in the balance sheet. Are you clear? So meaning my profits will go down or go up? Come down by how much? 1,060. Provisions equals minus 1,060. Come on, it can't get easier than this. It's obviously easy, right? Very, very easy. In February 2019, prior to the financial statements being authorized for issue, before financial statements are authorized for issue, Mervyn determined that some of its inventory produced in December 2018 had manufacturing defaults. Taking this into account, the NRV of the total inventory at 31st December 18 was determined to be 6 million. None of the damaged inventory had been sold. Okay, there have been inventory which is damaged. They said the NRV is 6,000. The cost is given here as 8,620. So inventory valuation, what do you have? You have an impairment. Inventory impairment. Cost of the inventory, and you have been given NRV. Now my dear, when is this happening? Prior to the financial year. Because this is happening prior to the financial year, actually this is happening in February 2019, your year end is 31st December 2018, but does this provide evidence of conditions existing as at the reporting date?
Yes. Yes.
Is it an adjusting item or non-adjusting event? Adjusting event, because as at the year end there is evidence of conditions existing as at the reporting date, so it becomes an adjusting event. This is the part A your examiner wanted answer for. Part A your examiner wanted to talk to you about, explain, there was an explanation area and that explanation was this. Are you clear?
So in case if that was after financial statements, then we don't adjust.
No, you can't. Then it becomes an error.
Error.
Opening retained earnings, should go and adjust it.
Next year opening.
And you bring down, there is impairment. There is impairment. So right now you can go and adjust your current year financial statements. So current year financial statements you are going to bring down by how much? 6,000 is here. NRV is 6,000. Your cost is going to be how much? Your cost they have given you, inventories is 8,620. Your 8,620 and 6,000. 6,000. Therefore, you have this minus this. 2,620 is your impairment of inventory to be written down. So, how will you write down? You will debit your P&L. Debit P&L. Credit inventory. Equals 2,620, meaning your inventory value, your profit will come down or go up. Your profits are going to come down. So therefore you have inventory write-off equals minus 2,620. Therefore our adjusted profits, would be equals sum 2,909 adjusted profits.
So could you show the note 4 again?
Yeah, I will. Are we clear, everyone? Are we clear, everyone? Are we clear, everyone?
And the inventory also.
Are we clear, everyone? Understood? Everybody understood? Clear?
So now it's working now. What's the problem is there's a power cut in our house, so I couldn't charge the phone.
Yeah, that's okay.
So battery load is
No problem. That is important. Phone is important. Don't worry, it's okay. Take it easy. Take it easy. Okay. So guys, we have entirely completed the schedule of adjustments. Okay. We have entirely completed the schedule of adjustments. That is done. Because Hasna, they say they have entirely calculated the 8,000 properly. So there is no problem there. They say entire 8,000 here. The carrying amount of the factory under construction was correctly calculated at 8,000, meaning they have entirely done that adjustment correctly. You don't have to worry about it. Okay. Now the requirement: prepare the statement of financial position of Mervyn at 31st December 2018. Okay, they are requesting us to prepare the statement of financial position. So we are going to prepare the statement of financial position. Okay, it's not a big area, right? It's a relatively small area. You want to try it? You want to start doing it on your own? Prepare the statement of financial position. You want to do it on your own? Statement of financial position. I'll give you about let's say okay. How many marks is this? Okay, let's try 9 marks. How many minutes can you take in the exam? 9 into 1.8. Okay, 9 into 1.8. 9 into 1.8. About 16 minutes you can take. I'll give you about 16-17 minutes. Okay, I want to see if you can how you can do it on your own. Okay, take your 16 minutes. Your time starts now. I want you to see if you can do it.
So, is there like any specific format for this as well? Like
No. You can just do your normal format. While doing this, you got to make sure that you take account. Of all your adjustments as well, whatever we've made. Okay, start now. Okay, let's start. Balanced. Okay. Okay, let's quickly start. Let's finish this off. And then schedule of adjustments for profits is done, and now we're going to do the statement of financial position. Okay, so we can say Mervyn's statement of financial position as at 31st December 2018. Are we clear? So we have assets, non-current assets. Okay, what are the non-current assets we have? We have property, plant and equipment, and then factory also. So we have property, plant and equipment. If you want, you can take everything together, no problem, or you can show factory separately. And they say property, plant and equipment already includes the factory, no, which is 8,000. So directly what you can do is you can take your property, plant and equipment amount, which is 36,000, equals 36,000. So forget about factory, property, plant and equipment plus your factory. Your factory is, your total factory is
7,000 plus 1,260.
initial cost out because it's taken 7,000 plus 1,260 minus 271, 43,989. That's your property, plant and equipment. Done. What's next? You can take your current assets.
So the 500
What is the 500?
we removed from admin.
Hmm?
We removed 500. That was admin expense.
So we removed it here. No? We only took 7,000. No? We didn't take 7,500. No? Clear? Current assets. Inventory. Current assets inventory. How much is the inventory? We made some adjustments. Our net inventory was 6,000. Correct? Inventory done. After that, what do we have? Trade receivables is also there and cash is also there. So we have trade receivables. How much is the trade receivables? 11,020, no adjustments made, equals 11,020, no adjustments made, and then I have got cash. How much is cash? 33,030 equals 33,030, no adjustments made. Therefore, my total current assets equals sum 50/50. Therefore, my total assets would be 50/50 plus 43,989, 94,039. Clear? And then I have my equity. I have my equity. Under my equity, what do I have? Share capital. My share capital is at 10,000, no adjustments, right? Equals equals 10,000. Do I have share premium? No. I have retained earnings. So retained earnings are how much? Retained earnings. Okay, what do we have? We have dividends paid. We have dividends paid, and then we have retained earnings brought forward 55,740 and draft profit. So draft profit is wrong. We adjusted it. So retained earnings brought forward 55,740. So retained earnings brought forward 55,740. Current year profits. How much is my current year profits? 2,909. And then dividends paid. How much is dividends paid? 7,240. Minus 7,240. This has to be a working, okay, below. It has to be a working, okay. Working number 7. Retained earnings. Therefore, your closing retained earnings would be $51,409. Therefore, retained earnings equals 51,409, And then what do we have? Revaluation reserve. But our revaluation reserve has exhausted. We entirely used it. So it becomes 0. Therefore, $61,409 is my total equity. And then what do I have? Non-current liabilities. Under non-current liabilities, what do I have? I have my loan directly 890, and then I have my provisions, warranty provisions. When am I supposed to pay? Next year. Yeah, current liability. Was it for some decommissioning cost? What? Okay. 31st is okay. Current liability, provisions. So only loan, is it? No deferred tax, nothing, right?
Trade payables.
Hmm?
Of non-current liability will be low.
Mm-hmm. Then you have trade payables. I saw not oatcakes, it's payables. And then I saw tax payables as well, correct?
Yes.
Okay, trade payables is given as no adjustments, right?
No.
3880. And then tax payable is 2,800, 2,800, and then we have warranty provisions, which is 6,000, 6060. Anything else? That's it. So therefore I can take my total current liabilities. Therefore $12,740. Total equity and liabilities would be equals 12,740 plus 19,890 plus 61,049, 94,039. Your question is balancing. Answer is balancing.
Sir, I have a small doubt. Sir, now usually we won't allow overall cost.
Mm-hmm.
So overall cost is like we create a provision for something we replace in the future, right? Like for a part of the. So if the question says they have created provision something like that and haven't specified.
You do not know overall cost when you will incur it. Here you know exactly the cost that you are going to incur. There is an obligation.
So if the question says they are creating a provision to replace a part like this, we recognize it, even though they.
Provided there is an obligation, a contractual or constructive obligation. Only if there is a contractual or constructive obligation, you can recognize it. If not, you can't recognize it.
So now let's say the part is 10,000. They are supposed to replace it in 5 years. So they provide 2,000 each year. So is it possible?
Then no. You have to wait until the obligation arises.
So they can't provide a provision of 2,000.
Done? Are we clear? See, it's a straightforward question. It did not even take us about 10 minutes to balance. In the exam, you have about 16 minutes to balance this. Okay, having said that, we have part A to do, correct? Part section C, we have done first, second and third requirement. We have the first requirement. Explain how the discovery of inventory defects would affect the financial statements of Mervyn Co. Okay, superb. Explain how the discovery of inventory defects would affect the financial statements of Mervyn Co. 3 marks in the exam. 3 marks, 3 points. First, they want to know how the discovery of the inventory would affect the financial statements of MCO for 2018 financial year end. They want to know for 2018 financial year end, how will this be affected? Okay, how are you going to answer? What are your 3 points? You have to plan your 3 points. Okay, now go back. What is the issue? What is happening? What is happening? In February 2019, prior to the financial statements being authorized for issue, MCO determined that some of its inventory produced in December 2018 had manufacturing defaults. Taking this into account, the NRV of the total inventory at 31st December 18 was determined to be 6 million. None of the damaged inventory had been sold. What is the impact?
The overall profits will fall.
Yeah, so they want to know what? They want to know, explain how the discovery of the inventory defects would affect the financial statements. Because you discovered what would happen. You have to give 3 points to get your 3 marks. Number 1, you have to tell the examiner if the inventory valuation will fall down or not. Number 2, yes, it is happening before the financial statements are issued to the shareholders. So you are going to talk about adjusting and non-adjusting event, and how that will have an impact in the financial statements. Are we clear? Are we clear? Shall we answer? Can we answer? 3 points. So part A. Okay. Inventory belonging to the 2018 year had manufacturing year had manufacturing defects which were only identified post year end. Correct? Which were only identified post year end. However, this provides evidence of conditions existing at the reporting period. Therefore, in line with IAS 10, this will need to be adjusted. That is number 1. I spoke about adjustments. You understand my point? Number 2. If the adjustments are made, inventory valuation currently carried in the financials will change. As a result, inventory will come down by how much? So you already have 8,620. Now it's 6,000. As a result, inventory will be written off by 2,620 and carried at how much? 6,000. Refer working, that was our working 6. You understand my point? That's the reason why I am making a change there. Are we clear? Do you understand why I'm trying to do it last? Because I can always go back and tell the examiner, look, you can go and check my working. Number 3. Overall, the profits will come down and inventory will come down by 2,620, and a disclosure of this has to be made in the financial statements. Understood? So that's my first, second and third point. My 3 points to get my 3 marks in the exam. Are we clear? Everybody, are we clear? Understood? Yes or no? Everybody? Okay, so with that we have completed of our mock, we have completed mock section C, first question. Now we have section C, next question. Okay, so we have obviously a ratio, a company analysis question, a ratio analysis question. Not the first time we are looking at a ratio analysis question. We've been looking at this in the past also. Yes, but what I want you to do is, I'll be doing this question tomorrow. We are here with print, okay? We are here, okay? This is what we looked at in terms of print. We're going to quickly finish it off and then get ready for pre-mock, because at 2:30, our visitors are also coming in. Okay, so let's quickly get going. Print, but we have nothing much. I mean, we have done the main part of it. Working's done, right? Ashwa, you okay? Hajira, you okay? Why don't I see you, Hajira? Page number 140. It's loading. Okay, anyway, until it loads, we know we have been looking at print, and with print we have looked at these workings, right? So all this is done, and we can directly look at putting up statement of financial performance of print. Okay, right? But then again, what we are going to do is we are going to put this up in line with IFRS 18 presentation of financial statements. Correct? IFRS 18 wants us to put up the financial performance under primarily 5 headings. So we've been given 5 headings, and we are going to work around these 5 headings. What is the first heading? Operating activities. So income and expenses from operating activities. Income and expenses from operating activities. Okay, so there you go, my income and expenses from operating activities, and then I'm going to take my revenue as always. Okay, everyone, I'm going to take my revenue. How much is my revenue? Someone please, how much is my revenue? equals 97,400. Did I make any adjustments? Let me go down. Capital, bank loan, share issue, reversal of bank loan, out, nothing, nothing, nothing. Inventory, nothing. Okay, nothing. Okay, nothing, nothing, nothing. Okay, so basically I have not made any adjustments in terms of my revenue. Okay, so that's it. So I can directly take 97,400. Am I clear? Yes or no? Does it take such a long time to load? Hold on, loading, guys. Why is life so unfair? Documents. Oh, please come here. Enjoying anything? In between, they ask us, "Are you enjoying it? Rate us." What nonsense! Are we really enjoying this crap? Let me see if I can at least download it. Guys, anyway, how much is the cost of sales? They have not given us cost of sales. Okay, they have not given us cost of sales. Question. Oh, I want to see the question, please. Okay, give me a second. I can't just simply wait. I want to see the question. Yes, please. At least if you can send me a screenshot of the question. Page number 100 and? Okay, I think now it's loading. Okay, wait. Okay, now it looks much better. Wait. Go. YGM 140 MMS London. It's not here, no. Oh, I was able to get the latest one only. Do we have the question online? ACCA print OFR question. Let's try our luck. I saw somewhere. Is it this one? Equity shares 29,600, revenue 97,400. Okay, I think I got it. Okay, guys, I'm gonna simply take it from here. Okay, right? Okay, now, basically, what have I done? I've taken the revenue. Okay, revenue done. Revenue done. Now I need my cost of sales. They say cost of sales is not directly given. Yes, cost of sales is not directly given. I agree. If cost of sales is not directly given, it's a manufacturing company. So you have to work around your cost of sales. What is cost of sales? Opening stocks plus purchases or production cost minus closing stocks. So how much is our opening stocks? Have they given us the opening stocks? How much is the opening stocks? Sorry? 6850. Our opening stocks are given as 6850. And then I remember we had also calculated the closing stocks. Am I right? Because they have given us 30th June 2012 here, and here they have given us 30th June 2011. So now see, your examiner can test you both ways. Now here your examiner is not directly giving you cost of sales. Your examiner is giving you the components of cost of sales, and you think, okay, you're busted. You sit and think, okay, where is cost of sales? Cost of sales is there, right there. The components of cost of sales is given. So your opening stock says 6,850 plus they've given you production cost. How much is your production cost? 6150. Your production cost is 6150. Opening stocks plus production cost, then minus your closing stocks. Your closing stocks, I remember we did an adjustment somewhere here. Here inventory is valued at 5,700. 5,700, after we adjusted everything, it's 5,560 inventory valuation, because there was an inventory write-off, correct? So minus 5,560. What the hell is wrong with my Excel now? So take your calculators, okay? Were you able to take 6150 equals 6150 plus 6,850 minus my inventory was how much? 5560 minus 5560. Do I have any adjustments? I have to check for any adjustments. Now, if it's cost of sales, the first thing that comes to my mind should be depreciation. Okay, if I have depreciation, I'm going to account for depreciation. How much is my depreciation? My depreciation I have taken as 2070. Am I right? Plus 2070. Anything else? Anything else? That's it. That's it. That's it. That's it. Do I have anything else? I have a 400. What is this 400? Where do I have the 400? 400, there is impairment. 400, there is impairment. So I can also take my 400 impairment. So my impairment plus 400. 63,910. Is that all? Is that all? Yes. Okay. I take my gross profits 97,400 minus 63,910, 33,490 is my gross profit. Correct? Okay. And then I can take my operating expenses. When I take my operating expenses, what do I have? I will have my admin expenses. My admin expenses. Okay. My administrative expenses. My administrative expenses are how much, my dear? My administrative expenses given to me already is 29,570 equals 29,570. Did I make any adjustments? What are the adjustments I made? Admin. I have a provision to provide. How much is the provision to provide? 3,375,000 plus 3,375. Anything else? Impairment is already taken, depreciation is taken, tax refund. So 32,945. And then what do I have? I have distribution cost. Distribution cost. How much is my distribution cost? They have already given me 7,200. Did we make any adjustments? No. Did we make any adjustments? No, I don't remember for distribution we are making any adjustments. So 7,200. Done. So that gives me what? That gives me profit before financing and taxes, the new term. Profit before financing and taxes, correct? So 33,490 minus 32,945. 32,945 minus 7,200 gives me minus 6,655. Minus 6,655, and now I have my finance cost. Correct? My finance cost. How much is my finance cost? How much is my finance cost? Equals already given to me. Finance cost is 750. But are we making any adjustments? Are we making any adjustments? Are we making any adjustments? Yes, if you remember, bank loan was calculated on the total amount. Now we have overcharged how much? 350. Now I need to reverse it. So minus 350. So gives me 400. So finance cost done. Now I have loss before taxes. My loss before taxes will be equals minus 6,655 minus 400, 7,055. Now what do I have? Taxes. But in this case I have a tax refund. Remember they spoke to you about a tax refund. So tax refund is going to bring my losses down. So my taxes are at how much? Taxes are at 2,530. Meaning I will have now equal sum. My losses have come down, which is 4,525. Loss for the year. Are we clear? Loss for the year. Are we clear, everyone? Yes or no? Okay. Now, Printco statement of financial position as of 30th June 2012. What will we have? Assets, non-current, assets. Under non-current assets, what do you have? Plant and machinery. Plant and machinery. Okay, you have plant and machinery. Let's go back to plant and machinery. How much do we have? We have plant and machinery cost 16,200, accumulated depreciation 7,290. But did we take the net book value finally? Yes, 5,340. Now you see, because I took 5,340, it's very easy for me. I can directly take it, 5,340. What else do I have? I have land. Land at cost directly given at 45,000. Land at cost directly given at 45,000. Land 45,000. Therefore, total 50,340. My non-current assets. Are we clear? And then I have my current assets. When you take my current assets, I will have what? I have inventory. Inventory, closing inventory, we already calculated somewhere. I think 5560, correct? And then what do we have? Trade receivables. How much is our trade receivables? Equals 25,010. 25,010. I did not see any provisions or any write-off, so that's out. And then what do I have? Cash. Cash and cash equivalents. How much is my cash and cash equivalents? 4,700 directly given to me. I can take it. So that is a positive balance. And then I have tax refund. Tax refund, I have a receivable, correct? 2,530 equals 2,530. And then I have non-current assets held for sale. Non-current assets held for sale. We did the calculation, and non-current asset held for sale was how much? This is inventory. Non-current asset held for sale. How much do I have? How much do I take? At 31st, at 30th June, I have 1,100. Therefore, my total would be, there you go, 38,900. My total assets would be equals this plus 5340, 89 to 40. Now I'm moving on to my equity section. My equity, under equity, what do I have? Share capital. Share capital is always whose share capital? It's a consolidation, so it's okay. We can take 29,600. 29,600. You shouldn't forget we did some adjustments. What are the adjustments? We reclassified the bank loan as capital. So how much did we reclassify? We issued share capital of 7,000, and then we have share premium. Share premium 7,000 already, but here once again we have 15,500. So equals 15,500 plus 7,000, total 22,500. And then I have retained earnings. My retained earnings brought forward here is 11,470 plus current year profit, which is minus 4,525. Did I issue any dividends? No dividends, so that is out. Clear? And then what am I going to do? I'm going to take my revaluation. Do I have revaluation? No revaluation, that's out. So 0. So I'm going to take my total 66045. That is my total equity. That is done. Let me go forward. What is next? I have my liabilities. Under my liabilities, I will first take my non-current liabilities. My non-current liabilities, what do I have? We have a bank loan. Okay, bank loan is there, but we made some adjustments to bank loan, correct? Our bank loan is already at 30,000. My bank loan is coming down. I have to debit my bank loan how much? 14,000. Meaning it becomes 16,000. Do I have any deferred tax? No deferred tax, but we have provisions. Superb, we have provisions. We have provisions for this year. Our provisions for this year. Our provisions for this year. Non-current liability 2,250. Correct, 2,250 taken. And then I don't have any deferred tax, any loan notes, nothing. So I can directly do my current liabilities. If you take my current liabilities, I know there will be trade payables. My trade payables are at 4,170. 4,170. Did we make any adjustments? What was the oh, we have a 350 liability to be adjusted, correct? We have shown a 350 liability, so I'm going to bring that down 3820. And then I just saw that there is a provision, so I'm going to take my provision, correct? We have a provision. We have a tax refund which we have already taken, so nothing to worry. My provision is 1125. That is also done. I did not see any interest payables, correct? I did not see any tax payable. There was a tax refund. Therefore, I have my total. My total will be 4945. Have you completed this question? No. I thought you guys would have completed this question. 18,250. Therefore, total equity and liabilities would be equals 4945, 18,250, 6605, 89,240. It does. 89,240, 89,240. It is balancing. I was not sure because yesterday I had the momentum. I knew the workings exactly. But today, all of a sudden, But yeah, we've done a good job. There you go. All right. With that, we have completed Printco also. Okay. We have completed Printco also. Correct. Now, guys, if you see overall, if you see how many questions we've done so far, we have done quite a lot of changes, isn't it? Questions, isn't it? Atlas, Kingdom, Dobry, Satar, Gold, Trades, Huston, Print, and then what is? Yesterday we did the pre-mock question. Huh? And then remember I shared some recordings. Did you start watching the recordings? The questions. What are the questions? Huston is there. Pallister is there. Huston, Pallister. Lingo is there. And then Chestnut is there. Paladin is there. Vyagem is there. Ade, who would have done this many questions when I've given you access to this many questions? This itself is enough for you. I'm sharing more actually. That's helpful, right? When you look at how I'm doing it, it's easy, right? Okay. Anyway, coming back, we are going to look at, we're going to go forward and we're going to look at our pre-mock. Let me take the pre-mock on screen so that, it's something that yesterday we did Mervin. Yeah. So I'm going to go to ACCA Global and immediately get our practice platform, FR, resume. Yes. So did you use the same meeting link like yesterday? Guys online, same meeting link? No, is it? It's a new meeting link. Can I get it? Okay. I'll check. Can someone send me this thing, please? Can someone send me a user ID password to log in? Why doesn't this work? Do they have this already? Let me to log in. 6444644 Let me check. Did you guys actually start going through the pre-mock? You did? Okay. Did you start doing the questions? Entirely done. How did it go? Good. Got it right. Can you actually go and check the answers? Okay. Okay, fine. Fine. Let's do it. Hi guys. Hi. Loading. Loading. Give me a moment. I'll get my water bottle. It has not loaded. Hi guys. I don't know what I can do with this. It's still not loading. I want to do the practice platform. Pre-mock. Oh, why is it so weird? Slow, right? It's very, very, very slow. Oh, okay. Someone has an audio. I don't know who it is, so probably because of that. Login. Okay, can I get a username password, someone? Okay. Okay, oh, I got it. Okay, super. ACCA. Sign by tutor, sign on. Yes. Thanks, Faizan. Select category. Do we have a bar? Okay, assigned. Okay. Assigned. View assignment. Okay, there you go. Pre-mock. Thank God. Good afternoon. Okay, not bad. Okay, shall we start, everyone? Hello, everyone. Good afternoon. And we're starting off with the pre-mock September 2025 uh, for the September mocks that is released by ACCA. Okay, having said that, we have completed a part of it, section C. I remember completing the question by the name Mervin. Mervin is entirely done. Now we are going to move on and look at the rest of the question that we have. And as you know, the platform is very, very, very slow. So you will have to give me some time. There's error. So even I can't access. I know that it's very, very, very slow. I'm struggling to access unless otherwise someone has taken screenshots. No, it's not working. You have screenshots. Okay. Huh? No, Rish. What did we finish? Mervin was ratio, right? No, okay. Do you have screenshots? Oh, okay, okay. At least share that. No, we can't just be wasting time, right? I mean, it's not working. But your really ACC exams, this is not going to be the problem anyway. Okay, that's a solid this thing. So, but you need to also understand the amount of students accessing the website. The volume has to be very, very, very high. So, could be that also. Okay, I've got the screenshot. So, I'm going to directly take the screenshots and start working on it. Okay. So, I hope that's fine by everyone. That's the only way out. Give me a second. I'm just getting the screenshots. Oh, don't we have it in a nice way? No. In a way where I can, it's easy for me to say. Because it's the first time I'm also doing these questions. It has to be smooth. Don't you have it in a PDF format? Does anyone have it in a nice, easy format? Yeah, you can send me the photos, but I want it in a way where, it's like Kaplan, like how they've given, it's easier for me to view it. Because even if I make a mistake, because for me, other questions, I know the questions. Here, since I'm doing it, I'm not too sure, because if I don't get the correct look of it. I don't know if it will work. Sorry guys, this is killing a lot of our time. It's working for me now. Okay. No, for me it's the same problem. Okay. Let me try through my machine at least. Okay, so I have it in my screen. Do you all have it on your screen? But having said that, it's a problem for our recording because our recording doesn't have it. But can I take screenshots from my screen? Okay. One last time, if it doesn't work here, then I'm going to go to my laptop. Now I just sent it as PDF. Naresh, requirement is not there. No? Do you have the requirement also? But in the meantime, since Naresh is sending me that, someone else, can you start taking the section A, section B for me, please? At least. Screenshot, okay. It's A, B, C, D, E, F, G, December. What time is this? Okay, I've got this. Fine. What's the next thing? They have sent me the entire this thing, is it? Okay, at least this. At least this would do, yeah. But I'm just worried after finishing this. Okay, this is fine. How will I? How will we go to section A and B? That's my biggest problem. At least this is fine. Let's say we can somehow get it. Okay, I think I'm okay with this. Okay, new. There you go. Okay, ABC is there. So yeah, this helps me. Okay, let me use good notes. Okay, there you go. Okay, something better. Something. Thanks. Okay, thanks, Asim. I've got section A entirely from DM. Section A and section B, if you can send it to me, it's better. It's going to help me. Superb. Okay. Explain how contingent liability of MCO should be accounted for by ByteCo on 1st of January 2018. Okay, the requirement says explain how the contingent liability of MCO should be accounted by ByteCo on 1st of January 2018. Okay, I think there is a group. They are a group. So basically they are asking you, in the group, you have a subsidiary probably, and you have the parent Byte. Byte acquires probably M. I have not read the question. They want to know on 1st of January 2018, how should they account for the contingent liability? Okay. Now, basically, even before reading the scenario, I know when you take contingent liability is generally not recognized. Why? Because the conditions are not satisfied. However, IFRS 3 overrides and says, hey, look, even if the conditions are not satisfied, you have to recognize it. IFRS 3 business combination device says, hey, fine, okay, fine, I know the conditions are not satisfied, but that is in line with IAS 37. For the group, when you are going to recognize, you have to recognize. So technically, contingent liability will be taken as a part of your goodwill. If it is taken as a part of your goodwill, it will reduce your net assets, because it's a negative figure. It will reduce your net assets. So your goodwill will go up. How many marks in total? 3 marks, is it? Okay. I'm getting to know that this is for 3 marks, so I'm going to make it 3 marks. So I'm going to give 3 points in the exam. Okay. Number 2, calculate the following ratios for the year ended 31st December 2018 and 31st December 2017 for the Byte Group and ByteCo respectively. Gross profit margin, operating profit margin, and return on capital employed. Okay, they want 3 ratios: GPM, OPM, and ROCE. How many marks there? Once again 3. Oh wow, really? So for the committing, we are getting 14 marks. Okay, so you see your examiner is slowly moving towards the commenting part of it, which is going to be for 14 marks is what is known so far. So therefore, we have quite a lot of work to be done. So GPM, OPM, and ROCE is not something that is new to us. We have looked at in the past, and we will start answering the way we normally do. Okay, now in the exam, we are going to read the scenario. Now we know the requirement, and we are going to read the scenario, and then we are going to start getting the ratios and putting our comments in between, building our points. That's how we do it. We know that. Okay, super. Now we can start reading the question. Together. B, a prominent food manufacturing company specializing in pre-packed meals. Okay. B is a prominent food manufacturing company which specializes in pre-packed meals. Okay. Purchased an 80% shareholding in MCO on 1st of January 2018. Okay. So they purchased on 1st of January 2018. Your last year, you have a single entity statement. This year, it's consolidated. They directly say that. We have looked into a scenario like this before. Fatima, have been acquired Fatima. From 2007, we looked at a question. See, after about 18 years now, I told you last week only, hey, look, I'm doing this particular question because I think something like this may come. Now, you see pre-mock, I never saw the pre-mock, it is there. So, going back, M, its sole subsidiary focuses exclusively on organic pre-packed meals. Okay, now from pre-packed meals, our subsidiary is focusing on organic meals, organic sources, organic sourcing. Now, when you take eggs, right, when you take eggs, you have normal eggs and you have eggs without cholesterol. Now, Arogya eggs is eggs without cholesterol. In India also, I think they have. So when you try to remove certain things from unhealthy things from a meal, or when you try to source it organically, the cost is normally high or low. The cost is normally high. So organically, if you are going to work on pre-packed meals, normally the cost is normally high. But yes, people are liking it. There is a shift. So we need to keep that in mind. This acquisition was strategic. They say, okay, it was a well-planned acquisition, reflecting the growing consumer demand for food from organic sources. Okay, so people are moving, like how we are moving to eco-friendly products, how we are moving to green energy, how we are moving from petrol-powered vehicles to electric-powered vehicles, battery-powered vehicles, solar energy. Like that, yes, there is a demand in organic foods as well, organic sources of foods as well. Extracts from Bright Group's consolidated financial statements for the year ended 31st December 2018 and Byte's individual financial statements for the year ended 31st December 2017 are provided. They say, okay, they are directly telling you, okay, look, there is consolidated and individual financial statements. Okay, what is happening? Revenue is going up. I can see revenue going up. Cost of sales is also going up. Obviously, if you take this financials, this includes a Byte and Munch together. Okay, so it includes Byte and Munch together. So obviously, Byte's Munch contribution is there in revenue. Cost of sales also will have it. GP, yes, it's going up. Operating expenses are going up. Operating profit is reducing. Operating profit is reducing. Profit before financing and income tax is also reducing, meaning there is nothing, they have not given us enough information there. Statement of financial statements, they've given us the extract, share capital, revaluation, retained earnings, and there is borrowing. So our retained earnings is going up, so probably that is consolidated retained earnings. Revaluation is also coming in. And then we have borrowed. Probably I do not know, because in the last question they borrowed to acquire Fatima. If you remember right, they went for a loan note. Okay, I do not know. On 1st of January 2018, when you started, the carrying amounts of all MCO's assets and liabilities were equal to their fair values. Okay, fine. Before coming here in the exam, I have information to do my ratios. So it's better to do the ratios, and based on the ratios, we know what has happened so that we can give our comments accordingly. Okay. So let's start doing the ratios. I'm sure by now you would have done the ratios because we spoke about it. If you have not done the ratios, I'm giving you about 5 minutes to do the ratios on your own. Okay, I'm giving you about 5 minutes to do the ratios on your own, but that's a bit too much, honestly speaking. But that's okay. I'm going to give you about 5 minutes to do your ratios. Okay, you can start off. So your examiner wants you to calculate gross profit margin, operating profit margin, ROCE. That's it. Oh wow. Okay. 2000 and 2017 and 2018 both, and then you have your comment section. Anybody, your 2017 and 2018 figures, please, for me? Okay, I told you 5 minutes. Okay, I'm not done. Okay, you can take your 5 minutes. Okay, there you go. Done. Anybody with answers? Anybody with answers? Anybody with answers? I need my gross profit margin for 2017 and 2018. For 2017, my GP margin will be 51,991 equals 51,991 over my revenue. My revenue is 160,000. 160,000, that is 32.4%. Correct? 32.4%. Number 2, for 2018, my GP margin is 60,000 over 220,000 equals 60,000 over 220,000, which is 27.27%. Okay, I can see there is a drop in my GP margin from 2017 to 2018. My operating profit margin 31,746 equals 31,746 over 160,000, which gives you 19.8% in 2017. Correct? And in 2018, 25,000 over 220,000 over 220,000, which gives you 11.36%. ROCE, your ROCE is your operating profit over your capital employed. Your ROCE will be in 2017 31,746 equals 31,746 over open brackets your equity 95,679 plus your non-current liability, which is 3,000, which gives you 0.3217 or 32%. Correct? And then 2018, you have 25,000 over 117,929 plus 8,000. Correct? Equals 25,000 over 117,929 plus 8,000. 19.8%. Okay. There you go. 19.8%. Okay. Are we clear? Guys, everybody, are you getting these figures? Everybody, are you getting these figures? My figures are correct. Are my figures correct? Correct? Is my figures correct? Correct? Super. Now, there you go. I have got my 3 marks in the exam. I've only got my 3 marks in the exam. Okay? Right. Revenue in the current year has gone down. Obviously, as I see itself, I know my GP margin. I'm going to talk about my GP margin. My revenue in the current year has gone down. That is an obvious fact. Okay. Revenue in the current year is gone down. I know that. Obviously, I know that. That's an obvious fact. What is the obvious fact? Revenue has gone down. Sorry, revenue has gone up. I'm sorry. Revenue has gone up. The current year has gone up. I'm sorry. My GP margin has also gone up. My GP margin has gone up. My revenue has also gone up. Wait. 2017-18. Okay. Oh, why am I confusing? This is my 2017. This is my 2018. Okay. My GP margin has gone down from 2017 to 2018. My GP margin has gone down. My revenue has gone. Now, in the exam, I know my 2018 figures is consolidated figures. 2017 figures is individual figures. Now, I have to bring that to the exam. Correct. So, the first thing that I'm going to do is, hey, look, my revenue has gone up. Correct. My revenue has gone up. My GP margin has come down. I know that. But my current year revenue is consolidated revenue. Okay. Super. I can say revenue has increased in the current year compared to 2017. Am I clear? However, current year revenue is consolidated, and last year, the name of the company is B. Last year, B was a single entity. Am I clear? So I'm just bringing in my points. Maybe I'll add something in between also as I read entirely. But you know, that is one point that I can of course talk about easily. That is one point, of course, that I can talk about easily without a problem. Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Okay. My revenue is going up. I know. My GP margin is coming down. There's a decrease in my GP margin. My revenue going up. My GP margin coming down. Okay. Well, okay, fine. Let's go back to notes. Let's try to understand what do the notes say. On 1st of January 2018, the carrying amounts of all M's assets and liabilities were equal to their fair values. The company had disclosed a contingent liability related to ongoing litigation concerning a food poisoning case. Okay, there is a food poisoning case. Okay. In its financial statement for the year ended 31st December 2017, this has had a fair value of 250 at 1st of January 2018. On 1st of October 2018, the case was settled at an amount of 310,000. Okay, so there is a problem. Now, your current year, in your current year, this 310,000 is an amount that you are paying. Correct? Yes or no? Where will that have an impact within my ratios? Which part of my ratios will be affected? Which part of my ratio will be affected? My operating expenses is affected. My operating profit margin is affected. Correct. My operating profit margin is affected. So, as I read itself, I'm building my points. So, there is a litigation charge paid this year. This would obviously reduce my operating profits. Correct. Now, we could also see that our operating profit has come down. Our operating profit has come down. So probably this has made an impact. So litigation charge paid this year has made an impact in our operating profit margin. But my dear, you need to keep that in mind. You need to keep something in mind. Now, this is going to happen every year, or is this one-off? It's one-off. Okay. Now I will build my point with that. Okay. I will build my points. I'm taking my points. I'm trying to, build my points. With my points, I'm going to build my sentence. Okay. So litigation charge paid this year. Okay. Now I know my operating profit margin and my operating profits are coming down. Correct. So I can obviously say operating profit margin has dropped in the current year. Litigation charge paid this year could have contributed to this. Correct. Are we clear? This is a one-off cost. So probably this will not be appearing next year. However, this is a one-off cost and this may not be seen next year. So I'm saying, hey, look, there is a problem. Yes, my operating profit margin has dropped in the current year. Yes, this could be due to number one, litigation charge paid this year. But this may not come next year. But I have a problem there. I have another problem. There you go. Ashfa says, Zian, look. This could affect the company's reputation. So provided this is not being spread among other people, there could be a slight risk of our products not being purchased. So I could also go on to say, as a part of my further information, additional information, and I need a conclusion. Correct? Additional information and there is a conclusion. Based on the conclusion, what is happening? I need further information about the litigation if the customers, if this is being spread among other customers and if my complaint levels are increasing. More information required on the litigation, and if there were any further complaints resulting in negative customer goodwill. Okay, this is one thing that I need further information. As a part of my further information, I would want to understand, okay, if there are any problems that is happening. Good one, Ashwa. I'm with you. Superb. That looks superb. I'm happy. Let's go further. So I know about this litigation and I know I have to talk about this litigation on top. Section part A. Okay. I know that. I'm coming there. Okay. M's individual financial statements for the year ended 31st December 2018 reflected revenue of 50 million. Okay, they say M's individual revenue was 50 million, meaning your consolidated revenue is 220,000. So from 220,000, if you remove your 50 million, exactly. So they say M's individual financial statement, that is our subsidiaries contribution towards this 220 is 50 million. So that means B's revenue would be 220 minus 50, which is going to be 100 220 minus 50 is 170 million. 170 million, 160 million, still yes, there is an increase, which is agreed. There is an increase. So B, individually there is an increase in revenue. Okay. Revenue has increased in the current year compared to the, however, current year revenue is consolidated. Last year B was a single entity. Further, after removing M's revenue of 50 million, B byte, which is B is still B's revenue has grown compared to last year. You understand? Still there is an increase in revenue. So we are saying, hey, look, there is an increase in revenue anyway. But if it has resulted in a drop in revenue, you're going to say, hey, look, if you remove it, like how we did it with Harbin. If you remove it, look, there is a drop in revenue. Then there's a problem. Are we clear? Super. That's the reason why they have given us, meaning to talk about that point. So we have a good point to talk about there. Now in the exam, I know, okay, fine, I've got 2 points. I need entirely 14 marks in the exam. So I'm going to make sure that my conclusion and my further information gives me about 2 to 3 points. And then I need about 10 to 11 points here. That's my objective in the exam. Let's go further. M currently focuses exclusively on manufacturing prepared meals. M is our subsidiary, correct? But it plans to expand its product range in the future to include cold pressed juices, food supplements, baby purees, and vegan meals. Okay, they want to expand their product lines. Okay. This decision comes as the organic food industry has become highly competitive. So we are in a highly competitive industry. If you are in a highly competitive industry, do I have price monopoly or not? Do I have price? Can I set the prices, or my prices cannot be set by me? Cannot be set. For example, if I am the only ACCA institute in Sri Lanka, I can set any prices that I want. If I have about 40-50 competitors among me, my prices have to be worked accordingly, correct? So I have price competition. Yes or no? I have price competition. So meaning my revenue can get affected. So going forward, where will that have an impact? Sorry? Where can my profits, my revenue be affected? Gross profit margin. So basically, although I have a new market, we have got into a new market, but this new market is a very competitive market. Are we clear? Organic food industry is highly competitive. Although there is a market, it appears there is price competition. It appears there's price competition. So if there is price competition, my revenue, my prices will be obviously affected. So since it's highly competitive, my pricing could be affected. Therefore, my revenue can fall. Therefore, pricing could be competitive, leading to fall in revenue or narrow profit margins. Narrow profit margins. Now see, I've got my second point also sorted. Are we clear? Yes or no? But for that, they have an alternative. What is the alternative? They say they are introducing more products. So still there could be more food coming in, varieties of food coming in, leading to probably higher revenue in the future. So there can be price competition. But since we are expanding our products, we are diversifying with our products, this could be compensated. Correct? Number 3. M is in the process of introducing more product. Where's that? More product ranges. Correct? And these are highly profitable. Therefore, revenue and profit margin can increase in the long run. M is in the process of introducing more product ranges and these are highly profitable. Therefore, revenue and profit margin can increase in the long run. So it's a potential market. So this appears to be a potential market. Are we clear? Understood? Are we clear? How many points I've given? 1, 2, 3, 4. I've given 4 points so far. Okay. So high profit margins, you're expecting high profit margin. In 2018 financial year, MCO incurred substantial research costs related to its strategy for expanding its product line and invested significantly in marketing its existing offerings. Okay. So you're investing, there's a lot of research cost and there is a lot of marketing expenses. Research and marketing expenses, what will it affect? Operating expenses. So our operating profits to go down, another reason could be our investments in research and then marketing expenses. Are we clear? Yes or no? B group has invested significantly in research and marketing as they are launching new products. Now these are going to generate high income in the future, but in the short run it's squeezing my operating profits. In the short run, these have resulted in operating profits being affected. However, with these products having high demand, profit margin and revenue can grow in the future or long run. So B group has invested significantly in research and marketing as they have launched new products. Guys, as they are launching new products, you don't have to worry about the spelling errors, okay? That's fine. Your examiner understands you have put launching there, no problem. Launching new products. In the short run, these have resulted in operating profits being affected. However, with these products having high demand, profit margin and revenue can grow in the future. How many points? 2, 3, 5 points. To finance these expenses and the future costs associated with the expansion, the company has secured a loan. Okay, now loan. What is the problem? Where will loan have an impact? Where could loan have an impact? My loan increases my financial risk, obviously. My interest covering, if I can cover interest, I need to understand my finance costs can be covered or not. However, they have not given me enough information about the loan. I do not know if there is enough money, my interest cover ratio is safe or not. I do not know the finance cost, correct? So, more information regarding the loan and finance cost. Number 3, it also brings me to a point where they have not given me current and non-current assets, correct? And I don't have my current liabilities also. I do not know the cash flow position of the company. So more information regarding the cash and working capital cycle of the company is required. You understand? You see how I'm building my points. You could see how I'm building my points, right? You understand? So basically, my borrowing could have an effect on my ROCE. So my ROCE could have gone down because I have borrowed. So ROCE going down. Actually, ROCE going down is for 2 reasons. Number 1, if you actually see, my operating profit is also down. My operating profit is also down, and my capital employed. My capital employed is going up. Yes. So the problem is 2. Number 1, my operating profit going down, and number 2, my operating profit going down and my capital employed going. So my ROCE is affected by 2 variables. So I can obviously start talking about ROCE is coming down compared to last year. ROCE is a primary shareholder ratio. Always use that. And this could be worrying to the shareholders. This could be worrying to the shareholders. Okay. Now this going down is obviously of 2 reasons. We have identified it, correct? Now, in the current scenario, ROCE is dropping due to a drop in operating profits and an increase in capital employed, and an increase in capital employed. Are we clear? Guys, are we clear? Guys, are we clear? Yes, Zamin, please send it. Please send it. Are we clear, everybody? Are we clear so far? Are we clear? Are we clear so far? Yes or no? So I can go on and talk about the borrowing. I can talk about the borrowing. B has borrowed in order to finance what? Marketing and research for the expansion. B has borrowed in order to expand. In order to expand, correct? In order to expand. So this could also cause an impact in ROCE, increase the capital employed. This has affected ROCE with an increase in capital employed. Capital employed. Are we clear? Okay. So see how am I justifying my points? I'm telling, hey, look, this is coming down, but why is it coming down? There's a reason for it to come down. Now, as I'm reading itself, I'm building my points. Do you see? As I'm reading itself, I'm getting my points sorted. You understand my point? So, but in the future, what do you think? In the future, since you are marketing, you're bringing in new products. Okay, so Akifa says, sir, if they can use the loan effectively, they can generate profits in the future. Okay, super. Now I can talk about that. Correct. So number 3, with new products to be launched, and organic markets growing, better utility of the loan can increase profit margin in the long run, resulting in a reversal of ROCE. Now it's dropping, so I'm expecting it to reverse in the future. Are we clear? Okay, super. And in the exam, how many points I have covered? 1, 2, 3, 4, 5, 6, 7, 8. 8, conclusion 1, 9, 10. Further information 1, 10. I have 14 marks, 4 more points to cover. Okay. Now I have not entirely read the question. I still have more to go. Yes. Right. On 31st December 2018, M revalued its sole factory. Okay, so there's a revaluation. Oops, revaluation can affect what? My capital employed. My capital employed can go up, right? All other categories of property, plant and equipment at B are measured using cost model. M follows the same accounting policies as B for property, plant and equipment. Throughout the 2018 financial year, M's properties accurately reflected their fair values, thus did not necessitate a revaluation, with depreciation charged in cost of sales. Okay, so if you revalue, obviously your cost of sales are going to go up. So that could also result in your GP margin being affected. Yes or no? There you go. So I can go to my GP margin. There you go. Okay, I have my second point. I have my, where are we? In the future. We are in the future. We are already in the future. Okay. Number. Where is it? 1, 2, 3. My 3, I come here. In my 3, I come here. And number 4. Okay, I got to my 4th point. Are we clear? Okay. Where is it? Okay. B has revalued B has revalued its what is being revalued? M has revalued its factory. Okay, not B. So B group M has revalued its factory. Correct? M has revalued its factory, right? Okay. This could, or this will result in higher depreciation. As a result, this could lead to an increase in cost of sales, affecting the GP margin. You understand my point? This will have an impact in our GP margin. Guys, online, everybody understood? Yes or no? Everybody understood? Yes or no? That's my fourth point. So my ROC is also affected, right? With revaluation. Number 4. In the current year, drop in ROCE is also contributed due to the revaluation of property of the factory by M. This obviously will increase capital employed. So yes, your capital employed is increasing. Your operating profit margin has no impact at all because of this. Your operating profits doesn't have any impact as well. So this has also contributed to your capital employed falling down. So here 1, 2, 3, 4, 5, 6, 6 plus 4, 10 already. Below 2, 12. I need 2 more points in the exam. You understand? See how I'm working through my answers. Okay, I'm not done reading. For a number of years, B has consistently achieved a 10% annual growth in revenue. Okay, they are saying B's individual revenue growth is 10%. Now we know when we look at this, okay, from 160 you have gone up to 170. So if it's 10%, it should have been 16,000. But our revenue growth is only 10,000. So although revenue is growing, overall we are not meeting our expected revenue target growth. Are we clear? That is another point. So where can I plug it in? Obviously under GP margin. Are we clear? Number 5. Number 5. Okay, number 5. What can we talk about? We are going to say, hey, look, although the standalone revenue is growing, your revenue target of 10% is not being achieved. So how many percent are you actually increasing? So 10,000 over 160,000 gives you how many percent? Although B's standalone revenue has increased by 10,000, which is 6.25%. 6.25%. This is excluding subsidiaries revenue. Excluding subsidiaries revenue of 50,000. Excluding subsidiary revenue of 50,000. Overall, there is a revenue growth target of 10%. This is not achieved. ACH achieved. It is not achieved. Therefore, revenue growth is falling compared to historical trend. Compared to historical trend. Why could there be a drop here? Why could there be a drop here? No, because their existing model is not successful, because customers are moving to organic pre-packed meals. So it also means that their existing model is not successful. This decline could be as the customers are switching to organic sources. Are we clear? Therefore, existing business model does not look sustainable, and revenue growth can further drop in the future. Yes or no? Okay, having said that, you have moved into a strategic acquisition. So we can say in the future, what is going to happen in the future? Your strategic acquisition could obviously increase your revenue. By considering the shift in customer demand, B has made a strategic, not tragic, it's strategic. Strategic. No, then it's a problem. Okay, it can't be a tragic. Strategic acquisition of M. Strategic acquisition of M. This is in line with customers' preferences. Are you clear? And this could turn the tables favorably, resulting in an increase in revenue in the future. No, we do 100% consolidation, right? Okay, so 6, 7, 8, 9, 10, 11. How many points here? 6, 7, 8, 9, 10, 11, 12. We've already got 12 points, okay? There could be already 12, below 2, 14. But something just came into my mind. I'm going to put that also. This year you purchased your subsidiary. When you purchase your subsidiary, what could you have? There could be a lot of legal expenses, transaction cost, legal expenses. All those could have also affected your operating expenses. Number 3, as the acquisition took place in the current year, there could have been legal expenses which affected the current year operating profits. Are we clear? This is a one-off expenses. This is a one-off expense. There you go. I'm done. So how many? 5, 6, 7, 8, 9, 10, 11, 12, 13 in the exam. I've given 13 points. I should have given only 12 points because here I'm getting information here. I'm getting my marks here in my conclusion. Correct. What could be my conclusion? What do you think about the overall acquisition? Good. Sorry. Overall, it's a good strategy. Looks fine. Overall, they are in line with the market expectation, what is required in the market. Okay. Overall, the acquisition looks well planned and thoughtful as the customers are shifting to organic sources. It is observed that in the current year, profits and revenues are falling. However, it can be noted this could improve in the long run with product diversification and more organic products being demanded. With M's acquisition looking potential. Further information required to make the analysis more conclusive. There you go. That's how I get my marks in the exam. 80% shareholding, but this is consolidated. Have I ever taken 80% like that? Don't be silly. Understood? Are we clear? Everyone, are we clear? There you go. That gives you your entire 14 marks in the exam. With that said, we can move on to finish off part A. We are not yet done with part A. We can finish off part A. Can we do part A also? Okay, let's finish off part A quickly. Superb. So part A, what does part A say? Part A says, explain how the contingent liability of MCO should be accounted for by B Group on 1st of January 2018. Okay. Now IAS 37 does not permit us to recognize a contingent liability as the conditions are not satisfied. So let's start off with that. Okay. So let's start off. Number 1, IAS 37 does not permit to recognize a contingent liability as the conditions are not satisfied. So probability of payment and measurability of cash flows are not possible. That's the reason. Number 1. Number 2, when it comes to group financial statements, IFRS 3 comes in between and says, no, you have to recognize it. However, when it comes to group financial statements, IFRS 3 requires contingent liabilities to be recognized at acquisition, even if the conditions are not met. That's what IFRS 3 says. It overrides IAS 37. KLP1, we spoke about it. At acquisition, even if the conditions are not met. Therefore, the contingent liability will be included when calculating goodwill. So what will happen to acquired net assets? It will go up or come down? Acquired net assets will come down, meaning your goodwill is going to go. Therefore, this will reduce acquired net assets and increase goodwill at acquisition for the group by how much? At acquisition, how much is it? At acquisition, it was 250,000 by 250,000. Yes. Are we clear? Everybody, are we clear? Everybody, are we clear? Everybody, are we clear? Everybody, are we clear? Okay, I'm giving you a few minutes. Quickly go through the answers one by one. And if you want to copy anything, just quickly take your notes. And then we're moving on to section A. Quick. You can quickly go through. You can see what's happening. How's it? Guys, look at the number of questions that we have done. You cannot fail. You cannot fail. Now you have to come with 85-90. Okay, it has to be 85-90. All possible scenarios I have covered. There is not a single area that I have not looked into. All possible areas covered. I'll share this sheet also. Okay, right? Can we move to section? Okay, let me take section A until you read. Somebody said that they have sent me the section A, but can I see if it is coming quickly? Shall we see if it is coming? Just let's have a look. Error. Resume. Thank you. Yes, remember I told you I'll be with you until the last day of the exams. You see, here I am. Now, 99% of me is over. Now it's you who has to do it. I think this is useless. Let me go back and see. Section B. Should I start with section A or section B? What should we start with? A. Okay. We always trust you. Thank you. Oh, okay. It doesn't look. No, it looks a bit blurred. Okay, you've done a good job, Basim. Brilliant job. But the thing is, when I put it across here, it may not look. Okay, I've got it from Zameen. Let's see. How has Zameen sent it? Well, the thing is, if it's not clear, you'll not be able to see it. Okay. Okay, Zameen has sent me. I think I can use this. Okay, I'll use Zameen's. Okay. No offense. Thanks everyone for sending it. Thanks everybody. Really, really, really helpful. But Zameen's looks a bit easier for me. Okay. So I'm going to use Zameen's and let's start. Thank you everyone. Super. I saw that. Guys, everybody out there, probably we have got all the marathon videos, right? So please make sure that it's on YouTube. You can watch it or you can share it with your friends. Someone will benefit out of it. Okay, there you go. Oh, looks scary, no? Okay, super. So this is number 2, this is number 1. Okay, I think I have to come reverse. Okay, fine. It's okay. Something's better than nothing. You've done a good job, mate. Okay, there you go. Everybody with me? Everybody with me? Everybody with me? Everybody with me? Yes or no? Can I get a yes? Okay, let's start. Indicating by clicking on the relevant boxes. Now, section A, you can be tested with multiple accounting standards. Section A is for 15 questions. You get 15 questions in section A. Section B also, you will get how many questions? You have 5 questions from each and every standard, but you can get multiple standards. Okay. Indicating by clicking the relevant boxes whether the following statements describing advantages/disadvantages of IFRS accounting standards are correct or incorrect. Okay, IFRS accounting standards, we've been entirely soaked with accounting standards. Yeah, entirely. So we know standards are issued by IASP, International Accounting Standards Board, and you have IFRS accounting standards. Improve comparability because they must be used by all listed companies worldwide. Okay, I want you to give me a quick answer. CI. Okay, number one, C or I? Used by all listed companies worldwide. Listed by all listed companies worldwide. Okay, now there's another problem. Don't send me personal messages because it's a bit tough for me to come back here. Just send it in the group. Okay, so it's easier for me. IFRS standards, not all listed companies, each and every country have their own, there are inbuilt standards by the company. So it's not by all, but you can use it, right? But it's not all, so that is incorrect. IFRS accounting standards facilitates cross-border investments. Correct. That's one of the purpose of IFRS accounting standards. IFRS accounting standards are suitable for reporting sizes of any size and type. No, it's not for any size and type, because if it's small, it's going to be a bit tough for you. IFRS accounting standards may be costly to implement. Yes, it is costly to implement because it's not easy. Incorrect. IASB follows standard setting process. IASB follows standard setting process when developing a new standard. What is the correct order of this standard setting process? Standard setting process order. Now I have in the exam for these two marks. For a mark I get how many minutes? 1.8 minutes. Now for this, now you see I did not even take 30 seconds. Quick. These are theory. I know it's quick. Here once again, I won't take much time, but I will give my time to see, okay, what is happening. Okay. So they want to know arrange the tokens below in order from step 1 to 4 of the process. Okay. Conduct a post implementation review. After you implement, you're doing a review. Issue a discussion paper if relevant. Issue an exposure draft. Consultation with IFRS Advisory Council about adding the topic to the IASB's work plan. Consultation, adding a work plan is going to be the first. So you're going to do number one. That's going to be the first thing that is going to happen. You're going to consult if you require an accounting standard. Number two, once you think, okay, fine, you have an accounting standard, you need an accounting standard, it has to be discussed. So that's where the discussion paper comes in. Number three, exposure draft is before finalizing, we issue an exposure draft to the public. Number three, and then a post implementation review. Number four. So 1, 2, 3, 4. 1, 2, 3, and 4. That's how you have to probably drag and drop. Are we clear? Which two of the following criteria must be met for an asset to be recognized in the financial statements according to conceptual framework for financial reporting? Okay, obviously by now you know, for conceptual framework for elements, any elements, obviously you need to have faithful representation and relevance. Faithful representation and relevance is the key criteria for you in order to recognize the financial elements in the financial statements. Okay, faithful representation. Do we have? Okay, there you go. Recognition of the asset provides faithful representation. Number 4, and then verifiability out, reliability out, relevance. It has to be relevance, so it has to be 2. So it cannot be 1 in the exam. You can't tick 1. You have to tick 2 in the exam. So it's going to be this and this in the exam. Okay. See, I'm not taking much time. Greek code. Okay, requirement. What amount should the building be measured in Greek code statement of financial position at 31st December 2018? Okay, you have a building. Greek, a company with 31st December financial year end decided to sell one of its building on 1st of October 2018. Okay, you have decided to sell an asset on 1st of October 2018. And immediately started to market it for the sale at its fair value. Okay, IFRS 5 non-current assets held for sale and discontinued operations. A potential buyer has been found to purchase the building in its current condition. The building is ready for immediate transfer to the buyer as soon as the price negotiations are complete, and the sale is expected to take place early, within 1 year. Meaning all the conditions for it to be a non-current asset held for sale is satisfied. So you don't have any problem there. The following information is relevant to the building at 31st December 2018, and they want to know what amount should be shown in the building as at 31st December 2018. Okay. Carrying amount when you decided is 500,000. When you decided to sell is 500,000. Your fair value when you decided to sell is 525,000. Your fair value. But now at 31st December is when you are looking for. So meaning at fair value at 31st December 2018 is 505,000. Cost to sell. So the standard IFRS 5 says if you have any assets that you have held for sale, it has to be carried at cost, net book value or NRV, whichever is low. Your net book value is 500,000. Your NRV is your fair value less cost to sell. Your fair value at 31st December, because this is happening at 31st December, my dear. It's not happening on 1st of October 2018, but on 1st of October 2018, anyway, you will bring it down. If you are going to take it for 1st of October 2019, if your question was 1st of October 2018, your answer would be 525,000 minus your 70,000 gives you how much? Can you use your calculator? You have to use your calculator in the exam. Your calculator, not one you see in the screen. Okay, please don't use this calculator in the exam. I don't want you to use that at all. So how much is it? 455, but your net book value is 500. So if your examiner wants on 1st of October 2018 your net book value, your net book value will be 525 minus 70, 455, your carrying value. But your examiner doesn't want you at that point. Your examiner wants at 31st December. If it is 31st December, 505,000 minus 70,000 gives you how much? 435,000. Your answer at 31st December means you have to take this figure. If it is on 1st of October means you have to take this figure. But for us, what is relevant is this. Correct? 505 minus 70,000, which is 435,000. Answer P. Are we clear? Understood? Okay. Indicate for each of the items listed below whether the expenditure should be included in the cost of inventory. Anything that is a part of acquiring the inventory is a part of our cost of inventory or recognized in the P&L in accordance with IAS 2 inventory. Okay. An allocation of fixed production overhead. So you have incurred it to produce this inventory, production overheads based on normal capacity, including the cost of P&L. Including the cost, brilliant. Abnormal amounts of wasted materials. It's not a part of our production, so it will go to P&L. Cost of storage after completion, obviously it cannot be taken as a part of my cost of inventory. It is P&L. Oh, come on. How long am I taking? Now you see how quickly I'm finishing it off. Okay. Teaco grows tea bushes on its tea plantation. You have tea plantation. On the tea plantation, you have tea leaves. Tea plantation, tea leaves. Obviously, plantation will be IAS 16. Tea leaves will be IAS 41, agriculture. Select the appropriate IFRS accounting standards that should be used to account for each of the components of Teaco's tea plantation by matching the correct token to the correct component. When the leaves from the bushes have reached maturity, you have the bush bearer plants. Bush bearer plants have reached maturity. They are picked and then dried. Okay, we are in Sri Lanka. I don't have to talk to you about tea plants. You have seen it through on your own. If I speak about strawberry, you know obviously. Okay, you're not seeing. Okay, how does a strawberry look? You do not know. If it's oranges or apples, we know it's a bit tough. But you know tea bushes everywhere in Sri Lanka. Ceylon tea. Okay, superb. So tokens, these are the tokens. I've got my components and I have to match. Okay, fine. Let me do the matching. If it's IAS 16, property, plant and equipment, my tea bushes are going to be what? Tea leaves at the time of picking and drying equipment. Tea bushes is going to be what? Tea bushes is going to be what? My tea bushes are my tea plantation. My tea bushes are my tea plantation. That's going to be IAS 16. My tea leaves at the time of picking, at the time of harvesting, it's going to be IAS 41. And I've got drying equipments to dry. It's going to be what? Once again, IAS 16. My tea bushes, my plantation, it's going to be IAS 16. My tea leaves at the time of picking, it's going to be IAS 41. Bearer plants. Are we clear?
Become inventory if it's tea powder.
Yes. But the drying equipment is equipment, property, plant and equipment. That is IAS 16. Are we clear? Got to be very careful there. Select the correct. Oh, okay. He has obviously taken and given it to me the screenshot. Okay, super. Thanks. Select the correct answer to describe the nature of the loan received. The nature of the loan received and the value of the benefit received. Value of the benefit received means what is the valuation, what is the total valuation that you get. In accordance with IAS 20, accounting for government grants and disclosure of government assistance. The loan received from the local government is considered to be a financial liability. The value of the loan of the government grant received is Tech received a 3 million loan from its local government to assist with expanding its business operations to build a private college. The loan has an interest rate of 1% and is repayable after 3 years. The prevailing market interest rate is 6%. So what is your benefit? Your benefit is when it's going at 6%, you're getting it as 1%. So your value, your obviously your value that you're getting is how many percent? 5%. Your 3 million over 5%. 5% interest on the loan amount over 3 years. Answer D. That's going to be your value. The value of the government grant received is 5% that you get. That is the 5% over a period of 3 million. In line with IAS 20, guys, accounting for government grants and disclosure of government assistance, a government loan below interest rate, below market interest rate, which is 6%, is a government grant. Obviously, the benefit that you get, the value that you get is going to be the difference between the market rate and the loan rate, which is 5%. Clear? Guys, are we clear? Which of the following statements is correct according to IAS 30? According to IAS 37, provisions, contingent liabilities and contingent assets. Which of the following statement is correct? Okay. Now let's read the question. What does the question say? GCO purchased land for its mining operations. GCO purchased land for its mining operations. The purchase date was 1st of August 2018. Government legislation requires that Golden Co restores the land after a period of 5 years. At 1st August 2018, the cost to restore the land based on an environmental expert's advice is 180,000. An appropriate discount rate is 6%. G has a 31st December year end. 31st December year end. Which of the following statement is correct according to IAS 37, provisions, contingent liabilities and contingent assets? Anybody? Answer. Such a cost and a corresponding expense in the P&L carrying amount 9800. When are you purchasing? You're purchasing on 1st of August 2018. 5 years. 5 years. Your year end is going to be 31st December. Okay. At 1st of 2018, cost is based on environmental expense. Okay. 80, I don't know. Okay. Calculator. Okay. Yeah, I have calculator. Fine. Answer. Anybody answer? Anybody answer? Anybody answer? So it's obviously what? Decommissioning cost, dismantling cost. Dismantling cost should be added as a part of assets cost or not? Should be added as a part of assets cost. Okay, added at present value, correct? So on 1st August 2018, GCO should recognize a provision equivalent to the present value of the restoration cost and a corresponding expense in the P&L. The carrying amount of the environmental provision at 31st December 2018 is 190,800. Correct? Not correct? No. Should recognize a provision equal to present value of the restoration cost. That is correct. And a corresponding expense in the P&L. We don't do that. No. We don't do that. No. Okay. On 1st August 2018, GCO should recognize a provision equal to the present value of the restoration cost and corresponding debit entry to land. Okay. So you are going to put a provision account and then you're going to debit land. Okay, that is correct. That is correct. Because you have to take it as a part of assets cost. That is correct. Super. The carrying amount of the environmental provision at 31st December 2018 is 190,800. 190,800. Okay, we have to check that. Now, how to check that? Your total, your present value is 180,000. I'm happy with that. But your discount factor is 6%. So 180,000 into 6% into how many months? August, September, October, November, December. Into 5/12 gives you how much? 184,500 total. 184,500 is what we are getting, it seems. I don't know. Please correct me if I'm finance cost 184,500. That should be added to the present value. So as at the year end, 180,000 plus.
No, that is the added amount. 4,500 is the finance cost and 180 is the present.
Okay, 4,500 is the finance cost. Okay, give me the figures correctly. 4,500. So 180 plus 4,500, is it? So this is out, no? That's out, no? This is out. It has to be C or D. On 1st August 2018, GCO should recognize a provision equal to the present value of the restoration cost and a corresponding debit entry to land. That is correct. The carrying amount of environmental provision at 31st December is 180 plus 4,500, 184,500. I'm happy with answer C. Provision equal to present value of the corresponding. Okay, this is out, no? Expense in the P&L is out. Answer C. Answer C. Answer C. Answer C. Everybody. Answer C. Aishwarya Varadrajan. Answer C. Correct. Indetco issued 20 million convertible loan notes on 1st of July 2013. Okay. Requirement, which statement is correct in accordance with IAS 32 financial instruments presentation. Okay, presentation. Okay. In 5 years time, on 30th June 2018, holders can choose to redeem the loan note for cash of 20 million. Okay. 20 million convertible loan note, you can choose to take 20 million cash or to convert them into a fixed number of ordinary shares or convert it. Okay. At 1st July that is today 2013, the present value of the loan note with a similar term but without a conversion option is 18.97. 20 minus 18.97 gives you how much? 1.03. Okay. They want to know the presentation. So you have present value 18.97. Your future value is 20. You have a difference, right? How much difference? 1.03. Okay. At 1st July 2013. Okay. Answer. Give me the answer. First year, should recognize the liability of agency and the loan also converted transfer to equity from the liability account. First year, equity loans are 1.03. The subsequent increase. No, it's not. It's out. Recognize over the. Yes. 20 minutes is that's out. Answer. Answer C. I'm happy with answer C. Correct. At 1st July 2013, Indetco should recognize a liability of 18.97, correct? And interest is recognized over a period of 5 years. Super. Good job. That's correct. Answer C. I'm happy with that. Super. Which statement is correct? Which statement is correct? 1.03. Yeah, it's 1.03. 1.03. Which statement is correct? Okay. Parent owns 35% of Kidco. 35% of Kidco, it's an associate. So P owns K. During the current financial reporting period, P sold inventory to K for 8,000 at a margin of 30%. Associate, parent is selling goods to associate. Okay, at a margin of for 8,000 at a margin of 30%. At the year end, the inventory remained unsold. Okay, you're not selling the inventory. Okay. P has recognized receivable balance of 8,000 for this sale, and K has recognized a corresponding payable. You cannot recognize an intergroup transaction between the parent and subsidiary. That is wrong. Okay. So they want to know which statement is correct. The URP is 2,400. No, the URP will be 8,000 into 30% into your percentage of holding, 35%. Correct. This is an associate, no? So 8,000 into 30% is 2,400 into 35% gives you 840. Okay, that has to be the URP. So I am confident 1 and 3 are not the answer. That's all. Correct, no? The unrealized profit element is 2,400. The unrealized profit element is 2,400. And the receivable and payable balances are cancelled in the consolidated financial statement. We don't cancel it. Correct, that's wrong. The URP is 840. Receivable payable balance are cancelled in the consolidated financial statements. No, we don't cancel it. So it has to be D. The URP balance is 840. Receivable and payable balances are not cancelled because you are not going to cancel in the consolidated financial statements. Answer D. Answer D. Because no cancellation required. Oh. How's it going? All good? Let's finish off section A and take a break. Okay? We have only 5 more questions to go. Right. Fitco owns a 40% shareholding in .co. Fitco owns 40% shareholding in .co. Okay. Associate. Which it gives significant influence during the year. Fitco sold goods to DCO. At the year end, .co still holds some of these goods. Okay. Select the correct tokens to reflect the consolidation adjustment required in relation to the URP in inventory. Who is the seller? Parent is the seller. If parent is the seller, eliminate it from parent's cost of sales. That is obviously your retained earnings is coming down. Parent's retained earnings, cost of sales, and credit investment in associate. So debit cost of sales and credit investment in associate. Are we clear? Increasing my cost. DCO has a year end of 31st December 2016. It entered into the following foreign currency transactions in the current year. Transaction 1. Okay. Requirement. Indicate which of the options are correct in accordance with IAS 21 foreign currency transactions. Okay. First of all, transaction 1. On 25th October 2016, BCO bought inventory denominated in a foreign currency At the year end, the inventory has been sold, however, supply has not been paid. Trade payable, monetary or non-monetary? Monetary. Trade payable is a non-monetary item. The trade payable is translated or not translated? Translated or not retranslated? Retranslated as at the year end. On 1st July 2016, B Corp purchased equipment to be used in its production. Equipment, monetary or non-monetary? Non-monetary. The equipment is measured using cost model and depreciated over the useful life of 5 years. Translated or not retranslated? Not retranslated. Which of the following options is correct? In accordance with IAS 21, foreign currency transactions. FCO purchased the building, paying for it in a foreign currency. The building was classified as investment property, and FCO adopts IAS 40 fair value model for such properties. FCO purchased the building, paying in a foreign currency. The building was classified as investment property, and F adopts IAS 40 fair value model for such properties. Since the building was purchased, its fair value has increased and exchange gain has arisen. Exchange gain has gone up, and then you have fair value increase as well. Which of the following option is correct? The increase in fair value and exchange gain should be recognized in P&L. Correct or not correct? You have a fair value gain, you have an exchange rate gain. Investment property. Ashfaq, correct. Answer correct. A. Because it's an investment property, fair value taken to P&L. Superb. 14 and 15, we have only 2. Okay, superb. Let's go. TCO manufactures, okay, requirement. Which of the following requirements reflects the correct accounting treatment for the brand in line with IAS 38? Oh, you would see this, okay? They'll just simply say, no, amortize the brand for 5 years, 10 years, 15 years. Stupid, that's wrong. Just ignore, okay? I never taught you anything like that. Okay, which of the following requirements reflects the correct accounting treatment for the brand? Take a minute. Tell me the answer. Give me the answer. Last option A. Thirst manufactures Q branded soft drinks. The brand was purchased from a competitor during the current year. Thirstco's management believes that Q's brand will contribute to net cash flows of the entity indefinitely. Which of the following requirements reflects the correct accounting treatment? Okay, they are not talking about 10 years, that's out. Amortize the brand over the maximum useful life of 10 years and test for impairment if indicators exist, that's out. Do not amortize the brand, but review the useful life when there is an indicator to check if there is evidence that it has changed. Test for impairment only if indicators exist. No, if you are not amortizing, you have to do an annual impairment test. Amortize the brand over a maximum useful life of 10 years is out. Do not amortize the brand, but review the useful life in each period to check if there is evidence it has changed. Test for impairment annually. That's what IAS 38 says. Test it for annually and whenever the indicators exist. Answer D. Are we clear? Why not C? No, because it's going to be investment property. Investment property, any gain or any gain has to go to the P&L, and any exchange gain as a part of investment property will go to the P&L. Complete the sentence below. Complete the sentence below by filling in the blank. In accordance with IAS 33 earnings per share, the basic EPS in 2017 presented as a comparative in 2018 financial statements is what? The following information relates to profit go at 31st December 2018. So you have equity shares of $2 each. 200,000 in the current year, and last year 50,000. Profit for the year is 160,000 and 95,000. During the year, there was a bonus issue of equity shares. Okay, no other shares were issued in 2017 and 18. Okay, they have gone only for a bonus issue of shares. They want to know what is going to be your comparatives. Comparatives means they want to know last year. When it comes to a bonus issue, we assume that bonus was always there. We assume that bonus was always there. So if I'm going to rework on my shares, that means I will assume that this 200,000 which is there in 2018 was also there last year. But 200,000 last year is the value. So number of shares last year would have been 200,000 over 200,000 shares. So 100,000 shares always existed is my assumption. So last year my profit was 95,000 over my shares were consistent, did not change, which is 100,000. Correct? So 95,000 over 100,000 gives me 0.95 or 95 cents. 95 cents. Answer 95 cents. Because I will always assume that this was there. Bonus issue shares. Superb. Okay, yeah, there you go. We are done with section A entirely. Section A entirely done. Start off. So, according to relevant IFRS standards, how will the legal cost relating to purchase of property 1 and its subsequent roof repair cost be recognized? Okay, property means I assume it's IA 16. So IA 16 is tested. Okay. Osborne purchased 2 properties on 1st of July 2017. Property 1 cost 900,000. Now they're talking about only property 1 now. Property 1 cost 900,000 and used by O as a head office. Legal costs relating to purchase were 30,000. During the course of the year ended 31st December 2013, O had to repair part of the roof at a cost of 2,000. IAS 16 assets are recognized that cost. Cost means all expenses incurred to bring an asset to its intended use. Therefore, legal cost, if you don't incur, you cannot purchase the asset. Therefore, 30,000 has to be capitalized. 2,000 has to be expense. The legal cost should be included as a part of the initial measurement of the building, and the roof repair cost should be recognized as an expense in the P&L. Correct. Answer is there. That's like, peanuts, nothing to worry there. I thought the pre-mock will be tough. Straightforward. What is the total amount that should be recognized in the statement of profit or loss in the year ended 31st December 2017 in relation to property 2? What is happening with property 2? Property 2 cost 300,000 and was immediately rented out to corporate tenants for 1,000 per month. 1st of July 2017, 31st December 2017. Okay, 1,000 per month. On 1st September 2018, O converted this property into a sales office. Okay, IAS 40 to IAS 16. The fair value of the building was 31st December 2017, 320. When you converted, it was 337. This year end 340. Okay. O measures own occupied property using the revaluation model and depreciates it over 20-year useful life. O measures investment property using fair value model. What is the total amount that should be recognized in the statement of profit or loss in the year ended 31st December 2017? Ho 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 ho. Look here. Well, on 1st September 2018 only they are converting. They want here 31st December 2017. These buggers have confused us with 31st December 2018 values also. You see? So when are you purchasing? 1st July 2016, 17. So they want until 31st December 2017. So for 6 months. For 6 months, this conversion does not have any impact. Correct? The conversion doesn't have any impact. For the 6 months, you have to pay 1,000 per month rent. So 1,000 per month into 6. That is 6,000 rent. Plus its investment property. At that point, from 300,000 to 320,000, there is an increase, fair value increase of 20,000. 20,000 plus 6,000, 26,000, income of 26,000, answer D. You have to be very careful with the dates. See, even for a moment, I got confused. Even for a moment, I got confused because I was wondering why did they even give this? Because I was working for 2018, honestly. I was working for 2018 and then, it's obvious. Guys, do you understand? These confusions have to be, you have to be very careful when reading these questions, okay? When students come and tell me, Zian, look, I finished section A and B in about 40-45 minutes, I laugh at them. 60 marks, 40 minutes, you just crap it out, man. You can't do that. You have to give your time. Your 1.5 hours for section C. Your section A and B, you need 1.5 hours. According to relevant IFRS accounting standards, what are the accounting steps that should be taken to correctly recognize the accounting conversion property 2 into a sales office on 1st of September 2018? Steps that should be taken to recognize the accounting conversion of property 2. Okay, property 2 is happening 2018. Okay, they want to know what are the steps. Okay, they are given us the answer. Transfer the property between non-current asset classification, statement of financial position. Measure the property at its fair value of 337. Depreciate the property. Depreciation should be your last item, correct? So your first item should be measure the property at its fair value. Number 2, then you transfer. Number 3, depreciate. Oh, that's straightforward. So measure, transfer, depreciate, obviously. Which statement best describes the accounting treatment that should be applied to the decrease in fair value of property 1 in the year ended 31st December 2018? Property 1, 31st December 2018. Property 1 is your head office. So you purchased on 1st of July 2017, 31st December. For 2018, there's a decrease. Okay. The decrease is always recognized in P&L. Yes or no? No. 17th one answer. This is 17th one, huh? Is this 17th one? I think this is what you're talking about. 17th one, income of 26,000. The decrease is always recognized in P&L. No, this is property, plant and equipment. IA 16. So that's out. The decrease is always recognized in other comprehensive income only. Correct? Okay, let's go further. The decrease in recognized in other comprehensive income to the extent that a revaluation surplus existed for property 1 and thereafter P&L. The decrease is recognized in P&L. Okay, this and this is out. These two look similar. But between them, obviously, to the extent that you can take to revaluation, you take. Anything extra, you take it to the P&L. I will go with answer C, okay? I'll go with answer C. Guys, theory. Look at the way they are testing theory. It's theory. No calculation. They have done the calculation. They'll give us the calculation. We're just going to do the theory. Which of the following properties which are also held by Osborne should not be recognized as an investment property? Oh, these are some of the properties they're giving us. Red House, which is an apartment block occupied by O's employees, all of whom pay market rents. B, which OCO's rents from an unrelated party and sublets. Okay, you rent it, you sublet, that is investment property. First one, you're getting PIM. Okay, point to note, very important point to note. Okay, an additional learning here. Okay, IAS 40 directly comes and says, IAS 40 directly comes and says, it's a direct point from the IAS 40 standard itself. If you have a property with you, if this property is given to your employees, your management, who is paying you rent, correct, technically it falls as IAS 40, but IAS 40 says you can't consider it as IAS 40, consider it as IAS 16. It's a direct statement from the standard. The standard says because your employees are part of you, they're not external people, because they are a part of you, apply IAS 16. Second scenario, you're subletting it, that is IAS 40, that is correct. No undetermined future use, that is idling property, that is IAS 40, we know that. Shopping center let to retailers or provides maintenance and security services. Very immaterial services. Once again, you are letting to retailers, that is going to be IAS 40. Answer has to be A. Point to note. Okay. Employees, the standard particularly includes a point which is any body management. If you have rented it out, they're paying market rent. We know it looks like IAS 40, but no, consider it to be IAS 60 because employees are part of your company. Okay, so we're done with that. We have another 10 more questions to do. And as we know, 16 and 17 answers, please. 16 and 17 answers, please. Okay, I'm going to quickly, make you check this so that you can get the answer if you want. One by one, okay? Done, yeah? Okay. Okay, in accordance with IFRS 3 business combinations and consideration, in accordance with IFRS 3 business combinations, the consideration transferred to acquire the 85% equity shareholding in D. What is the consideration paid to acquire the 85% equity shareholding? Okay. Let's see. It's going to be our investment cost. Okay. B Co acquired 85% of D Co's 250,000 shares on 1st of January 2017 for 1.45 per share. 1.45 million. Look at the way your examiner is confusing you. We will normally take it as 1.45 share, right? 1.45 million. Cash payable immediately. If not, how I would have taken. I have taken, okay, 1.45 number of shares into, percentage into 1.45 million. And for share exchange in which one B cost share was exchanged for every 2 share acquired. The market price of B share on 1st of January 2017 was 15 and the price of D's share price was 8. B has elected to measure NCI interest in D at fair value, and the share price at the date of acquisition can be used. Okay, now here they want only the business combination, your investment cost. Your investment cost is going to be, there is a cash consideration, there is share exchange. Okay, cash consideration is 1,450, 1.45. Your share exchange will be 250,000 shares. 250,000 shares, you are acquiring 85% into 2 over 1, right? In which one share is given for every 2 acquired, 1 over 2, okay, into 1 over 2, and the market price per share of the parent is 15 into 15 gives you how much? 1593.75 total. How much? 3043 3043.75. 3,043,750. 3,043,750. Correct? Okay. Done. In accordance with IFRS 3 business combination, what is the fair value of identifiable assets acquired and liabilities assumed on the acquisition of DCO? Okay. So we are going to see the total net assets, acquired net assets. Okay. The following information related to DCO at 1st of January 2017. Retained earnings and share capital. Retained earnings and share capital. Okay. Acquired net assets means number one, we know we are going to take the share capital. Correct? We are going to take the share capital. Correct? Right. Super. Now, how much is the share capital at acquisition? We might think it's 250,000, but it is 250,000 shares. The value is 650. 650,000, and then retained earnings at acquisition. Is it a mid-year acquisition, by the way? Oh, no, they have directly given us 1st of January. 1.2 million, correct? 1,200,000. The carrying amount of all recognized assets and liabilities of DCO were considered to be equal to their fair value at this date, with the exception of land whose fair value is 200,000 greater than its carrying amount, meaning there is revaluation. Correct? How much is revaluation? 200,000. Guys, all this we have done it in the past. Okay, we have done a lot of questions like this. Greater 200,000 in its separate financial statements. D had not recognized the provision for a present obligation of how much? 140,000. That had only 30% likelihood of being settled. This had a fair value of 90,000. At 31st December 2018, the matter to which the present obligation related had not been resolved, its fair value remained unchanged. Okay, you have a provision. Provision which you thought is 140 has a fair value of 90. What should you take? You are taking this at fair value, right? Everything at fair value. How much? 90,000. There is a provisions. Add on, deduct 90,000. What else do they have? In the year ended 31st December, D made profits. Okay, company's profit not relevant here. Net assets, other comprehensive income 54,000. Goodwill was considered to be impaired by 20%. And then you're selling goods. So acquired net assets 650 plus 1.2 million plus 200,000 minus 90,000 gives you 1850, 250, 250 minus 90, 1960. Answer? Total acquired net assets only they are asking. What is the fair value of the identifiable assets is what they are asking. They are not asking at 85%. Total value of the acquired net assets. They are not asking the percentage. 1960. Answer C. Are we clear? What is the carrying amount of NCI interest in DCO reported in the consolidated statement of financial position? NCI interest means they are talking about what? They are talking about NCI share of net assets. Okay, I told you a shortcut. You have to use a shortcut. Your investment cost plus post acquisition profit. Investment cost plus post acquisition profit. Okay. Wait, in the meantime, what is happening? Okay, we were here. In the year ended 31st December 2017, DCO made profits of 75,000 and reported other comprehensive income related to financial assets of investment of 54,000. Okay, you have profits plus other comprehensive income value also. Okay. At 31st December 2019, goodwill in DCO was considered to be impaired by 20%. Okay, superb. So we have to only get our NCI interest. So investment cost. Investment, I gave you the shortcut. Remember, investment cost. They say we are going to use the fair value method. So fair value method means share price is 8. In total, 250,000 shares into 15% into 8 gives you 300,000. From this, what do you do? Plus post acquisition profits. PAP. Post acquisition profit is how much? 75,000 and 54,000. You have both. So you have financial asset investment gain also. 75,000 plus 54,000 gives you how much? 75,000 plus 54,000 gives you 129 into how many percent? 15% gives you how much? 19,350 plus 300,000. 319,350. No, answer is there. Answer D. 319,350. Answer D. 319,350. Answer D. Understood? Oh, okay. This is missing now. I think match the tokens below to those that correctly reflect the consolidation adjustment required. In respect of the sales made between GCO and BCO. What is this GCO now? We are looking at BCO now. Yeah, BCO. DCO now we are looking at. Where is GCO coming? Oh, there is not an associate, there is a subsidiary. There's another subsidiary. Okay. So BCO also holds a 75% equity shares in GCO, another company. During the year ended 31st December 2019, GCO sold goods to BCO for 120,000. You're selling goods for how much? 120,000. Charging a markup on cost of 20%. Markup on cost of 20%. A quarter of these goods were still held by BCO at the reporting date. Okay, they want us to match. Who is the seller? G sold goods to B, no? Subsidiary sold. So 120,000 into 20 over 120 gives you how much? 20,000. Out of this 20,000, 1 quarter is still within the inventory. So 5,000 is going to be your URP. In your inventory, you will take 5,000. In your NCI, who is the seller? Subsidiary is the seller. In your NCI, what will you do? In your NCI, you will deduct, since the subsidiary is the seller, you will take a portion of this. How many percent is NCI? 5,000 into 25%. How much is that? 1,250. So 1,250 will be relevant to our NCI. Are we clear?